Hi, Danny speaking. That's all right.
Stan, Danny, can you just say the notes will be available later? They aren't available yet.
David?
Yeah, Stan. Stan, there's a query here about the notes.
David?
Yeah. Can you hear me? Yeah.
Are you there?
Yes, I'm here. Can you hear me?
David Tucker?
Yeah, I can hear you, Stan. Oops, how do I start video? Can you hear me?
Do you have notes for the second session, for your session?
Not yet.
Your sound
I've
is
had a
off.
change. I changed the content in midstream, so I'm just editing slides and things, but we can do the presentation. I can make the notes available later. The slides are fairly comprehensive and detailed, so if we run through
participants in the meeting, do apologize. We're running a little late because we're having Muneer Hassan is having some difficulties joining. It's a technical problem. He was on a little earlier, keeps coming back, and we're just trying to resolve that. So if you wouldn't mind just bearing with us. David, if you're available, we may call on you to start earlier. Not too sure.
Oops.
Just give it a few more minutes.
Sorry, have I pushed the button by mistake? Okay, recording. I need to get to my slides.
You want to share yours in the meantime, or?
Yeah, let me just get the windows. I need to get out of this one. Which one is this? Don't want to get confused. Okay.
I apologize again.
Danny, how do I get my slides?
Danny's trying to get hold of him to see what the issue is, but we are experiencing technical difficulty. I don't know whether it's a power problem or it's a Wi-Fi problem or internet issue, but we hope to start soon. Danny's trying to get hold of him. As I said earlier, Muneer Hassan was on the call and then it was dropped.
There we go. Should be on now.
Okay.
And we just need to go
How do I get rid of
F5. Yeah.
Okay.
So let's start with David. I'm going to just email and talk to him and just check what's going on. David, all the best. Take it away.
Oh, I hear some music. Good afternoon. Can everybody hear me?
David, are you hearing me?
I can hear you, Stan.
Your sound is off. You need to switch the computer sound on.
Let me just get to my, oops. Page up. I just need to Wait, I'm not a. I'm doing all sorts of funny things. Mute my audio. I'm not on. Stan, I don't know how to get my sound back on. New share, pause share, remote participants. Danny?
We can hear you.
Stan couldn't hear me just now. Can you?
No, you've come back on. It's fine.
Will I come back on? Okay. Okay, afternoon, everybody. I must apologize. I have had a change of content, or I changed some of the content of my presentation to make it more specific for a few issues rather than having a broad scattershot approach. So I will be completing my slides and sending them out as soon as possible through Danny and Stan. Once again, my apologies for that. The slides are fairly comprehensive, so I hope you don't have to make very many notes. In fact, there's probably more information in the slides than you actually need. Is my sound okay? Not too loud? Danny, Stan?
Sounds fine now.
Okay, okay. I want to talk about compliance. I want to focus on the issue of compliance in sectional title schemes from the point of view of the question of handling the administrative and reserve funds, on the maintenance plan. I think that's and some of the more specific issues relating to audits and how these relate to audits. Let me start running through. As you're aware, the Community Schemes Ombud Service Act came into effect in 2016. This is what's called the Csos Act. It governs the functions of the Community Schemes Ombud Service, or Csos. I'm going to run through this fairly quickly, just to refresh those who have seen my previous presentations, attended them, or for those who don't know. It's important. Every scheme has been required to register with Csos. Csos has been making an effort to contact schemes, but it's a legal obligation and it's subject to criminal penalty if schemes do not register with Csos. One of the issues that I'd like to look at today is the question of the role of the auditor in this complex environment of sectional title, because it's a complicated situation where schemes, trustees and owners are not fully au fait with all the legal technicalities and rules and requirements for schemes. Also, managing agents in many cases do not perform an educational function and train and teach trustees and owners in the obligations of managing and running bodies corporates, and consequently the audits that have to come out of these. And the question is, how do auditors deal with imperfect situations? A previous presenter spoke about the question of risk a month or two ago. The fact that many auditors do not want to tackle sectional title schemes because of the risk involved. Risk due to imperfect record keeping, failure to comply with requirements, and uncertainty as to the role of the auditor in the scheme, in addition to the looking at whatever financial transaction information they have. For instance, does the auditor have a mentoring role to try and also teach and get bodies corporates back on track? What is shown in the independent auditor's report? Does the auditor have any comment on the report of the trustees, highlighting shortcomings in the scheme and its management? Because one of the requirements is to report on the effective management of the scheme. And then the questions of matters of emphasis come up, and reporting of irregularities. Now, for instance, failure to register a scheme, here are the requirements. For instance, could be a reportable irregularity if the scheme doesn't do it. And I'm aware that many schemes, many bodies corporates don't want to approve their audited financials if there are qualifications of different degrees in the reports. Okay. One of the new sectional title and community schemes of legislation from 2016 introduced quite a few changes, both in additions to the requirements for compliance, or tightening up on the requirements through tighter resolution requirements, where trustees, instead of taking ordinary resolutions, have to pass written resolutions, or taking some of the functions from trustees and putting them into the hands of the owners at general meetings for special or unanimous resolutions. One of the new issues that came up is the requirement for Fidelity Insurance. Once again, here is a fairly comprehensive listing of the Fidelity Insurance requirements, whereby bodies corporates must obtain sufficient fidelity insurance for losses which a body corporate may incur, either through its executives or employees or contractors of the scheme, the managing agent, and so on. There is the regulation and the Csos Act does specify, for instance, a 25% requirement as opposed to operational budget, as you can read. As I said, this is a fairly comprehensive listing of the requirements for fidelity insurance cover. It applies not only to sectional title schemes, but the rest of the community schemes as well in this environment, being homeowners associations or share block schemes or retirement schemes from the agent. But as we're looking at sectional title schemes, you can read through this requirement for fidelity insurance. And this is one of the things that is necessary for the auditors to look at, to see to what degree does the fidelity insurance comply with the requirements as part of the audit process. Another introduction since 2016 that came in the Ombuds Act, the Csos Act, is the requirement for community schemes to pay over levies and to submit annual returns to Csos. So as you're aware, each scheme must quarterly pay over levies to Csos. These levies are based on the number of units in a scheme, where every unit is required to make a contribution, whether it's a primary section, which is, for instance, a residential unit or a factory unit, or it's the main unit in a scheme, which is the purpose for which the scheme is established, it also includes what's called utility sections, which are things like garages, parking areas, storerooms, where those are registered as sections. You'll note that one of the requirements that has to be submitted annually is an annual return. There's a copy of the financial statements and other information which Csos requires. So from the audit point of view, your audited financial statements go through to Csos on an annual basis. There is a bit of confusion within the sectional title rules. The rules say that if all the sections in a scheme are owned by the same owner, there is no requirement for an audited financial statement. However, the Csos Act requires an audited financial statement. I haven't been able to get an answer to this particular question, this conflict. I am trying, and I will get back to you at some stage when I have something more definitive. I have sent a query through to Csos saying what is their expectation. So I'll try and get back to you as soon as I can on that score. Here is information about the Csos levy to help you. It's obviously that you need to check the correctness of the levies when you do the audit or check the audit. And it's also important to check the participation quotas and the calculations of the levies, which serve as the source documentation for the calculation of the Csos levies. So it could be that schemes operate purely on a participation quota basis, or there might have been some resolution in the past where the body corporate decides to levy sections in schemes on a basis other than participation quota. So it's important for auditors in the audit to check the correctness of the levies according to whatever quota is determined, whether it's by default or by resolution. These slides will be in the notes when I send them through, so I will be skipping through some of them. What I do want to point out is that this year, in May, Csos put out a circular for the amendment of rules for sectional title schemes. It's a fairly comprehensive document. The Csos vets all or does quality assurance on all changes to rules and new rules which are now sent through. Previously, rules had to be sent through to the deeds office. Rules now get sent through to Csos, who now look at it, do quality assurance, and issue a certificate if the rules meet with Csos approval. So from an audit point of view, one would want to see the Section 10 certificate, Section 10 of the Schemes Management Act, which is the certificate approving the rules. And rules cannot be enforced until that Section 10 certificate has been issued. I would presume that these certificates are issued in respect of new schemes and rules to changes to rules since 2016, but obviously the thousands of schemes which have been registered before 2016, I don't know to what degree Csos has been issuing certificates for their rules, which were in existence before 2016, or tells the schemes to correct defective rules, because what Csos has done in the circular is they've listed a number of prohibited rules, rules which may not be enforced because for various legislative or constitutional reasons, they aren't enforceable. Some schemes, for instance, have in their rules provision to terminate electricity or terminate water. which has been ruled unconstitutional and irregular. There might be penalties and fines which are imposed by bodies corporates. Csos says that these rules may not be enforced unless they meet certain guidelines laid out by Csos or meet rules of natural justice. So, for instance, where there are penalties and fines in the statements of comprehensive income, auditors should look at the rules which in those rules which authorize those penalties and check prima facie on the surface, would they meet the requirements of Csos? If not, then the body corporate needs to have them amended so that they can be enforceable. There are large numbers of complaints which go to Csos about penalties which are imposed, because in some cases these might have to be reversed if a conciliation or an adjudication at Csos indicates that those rules aren't valid. I do give the reference. It's Circular 1 of 2021, dated the 6th of May. As you're also aware, there are a number of reasons for which owners, tenants, people who can use the relief complaint process at Csos can go to Csos, and one of those is financial issues. So it could very well be that at an audit stage, one can check which financial issues have been referred to Csos and see whether there is an implication for an auditor to report on at the time of producing the auditor's report, because some of these complaints may result in matters of emphasis if they are serious enough. I think that covers the issues from the point of view of compliance with Csos. I want to look at issues from the point of view of the Schemes Management Act. As I mentioned earlier, the agenda of an annual general meeting includes an item to appoint an auditor to do the audit of the annual financial statements, unless all the sections in the scheme are registered in the name of one person. And as I've indicated, I'll try and get back to you on this particular question to see what does Csos require. These are small, maybe duet schemes, or it could be schemes of 4, 5, 10, 20 units, although there are schemes of a couple of hundred units, which may be owned by a parastatal or a government institution, or it could even be one of the affordable housing companies. Next slide. I have slides here which just refer to the change which took place in 2016 as to who is required to undertake the audit of a body corporate. If you recall, that the accounting officer competency fell away, and it became the competence of auditors registered with URBA in terms of the Audit Professions Act, in the URBA Act. I include a couple of a slide referring to managing agents. This particularly comes into effect because managing agents should have fidelity certificates if a person performs the function of a managing agent. This is also something to check at the time of an audit, because that comes to the Fidelity Insurance. So in terms of this definition, you could have owners, you could have employees, people other than registered managing agents performing the function of managing agents. One could also look at the definition of the Estate Agents Act, the Estate Agents Board Act, where people who take money, perform services for money, could be considered managing agents, or people who perform what we take as the normal functions of managing agents. Okay. You might have a question about this at the end of the presentation. There's also a definition of a scheme's management service, which is different from a managing agency. But I will qualify this at a later stage. This slide relates to the reporting of changes or lodging of amendments to the scheme, as you are aware. You're also aware that the new Act, the New Schemes Management Act, provided for a change in the financial year end of a body corporate from February, which was the case from the initial Sectional Titles Act in 1971. Probably a sensible decision because of the volume of schemes and the load that auditors have at the end of the financial year, 28th of February, for tax purposes. It has now become the 30th of September for schemes since 2016. But once again, the requirement of, there is the requirement that should schemes have or choose a financial year end date other than the 28th of February or the 30th of September, it does require a body corporate resolution to change. And one would want to see proof of that resolution at a general meeting. A repeat of my previous comments. This slide just deals with some changes but from the previous Sectional Titles Act into the Schemes Management Act, just for information. These are slides that you're probably aware of, requiring the requirements for auditors and accountants and bookkeepers in schemes. You will note that one of the requirements, of course, is the issue of the keeping of separate accounts for a reserve fund and for what's called the administrative fund. A very essential issue. The reserve fund is there to provide, there will be slides further on, to provide for the present and future maintenance of the scheme. It's also related to the maintenance, or what's called the MRRP plan, the maintenance, repair and refurbishment plan or replacement plan, which serves as the basis for the future planning for maintenance in the scheme. It's a 10-year plan. Probably in some lower income areas where the financial burden is too great, it might be necessary to have a 15-year plan, for instance, to make the maintenance of the scheme more affordable. What this does is the future maintenance, repair or replacement activities of the scheme are reduced to some kind of spreadsheet. It should be as detailed as possible. Some schemes reduce it to purely a 1- or 2-page document, which isn't a good foundation for future planning for the scheme. And then the annual activities, of course, then would reduce to the amounts which go into the budget for maintenance activities, repair and replacement activities. It's important that these maintenance plans be kept to. The plans are the responsibility of the trustees. They then table the maintenance plan at an annual general meeting where it is approved by the members of the body corporate for the year to come, subject to any amendments which the owners in the scheme would want to apply. But the maintenance plan has now become an essential part of the body corporate's activity, and it's to stop ad hoc conducting of activities purely when someone says, well, let's do something. It's also to keep a focus on the maintenance issues. It's to give proper costing. And it's also designed to stop the use of special levies and the creation of special levies. Because unless there's a specific reason for a special levy, which might be an emergency or some unforeseen activity, it should not in the general run of affairs be necessary to institute special levies in a scheme. Where special levies are introduced for maintenance activities, it could very well be, but that's because of poor planning and lack of foresight as regards maintenance. Obviously, there could be special levies introduced where, for instance, one receives a sudden increase in a municipal account or some other claim which may be made against the body corporate. But as far as maintenance activities go, unless there are emergency things like an major electrical problem, plumbing problem, structural problem, all other maintenance activities should be done through the maintenance plan. Some points on the annual financial statements. Excuse me. I'm sure that you're all aware of these provisions. These are the requirements in the audit opinion. And I'd like to point out just the item 4 at the bottom of the slide, which refers to the financial affairs being effectively managed. Okay, sorry. The financial affairs, or the effective management of financial affairs, I think, is more than just the correct the recording of the financial transactions. Excuse me. I just need a sip of water. But it also applies to, from a compliance point of view, whether the body corporate has taken proper resolutions, either by the trustees or by the members in general meeting, for the approval of many of the operations and activities of the body corporate, be they administrative or be they financial. The Schemes Management Act changed the focus of the management and administration of the scheme by tightening up on the control of activities, either by requiring a number of decisions of the trustees to be taken by written resolution rather than just a normal ordinary resolution. Excuse me, this is to properly record the resolution. And one must bear in mind that the requirement in the rules, the management rules, is that resolutions be properly formulated and properly recorded, either in minutes or separately, or in writing separately, but that they don't just be summarized decisions that wording that the meeting or the trustees resolve to, and in 2 lines they take a decision. It should be proper wording so that there's clarity of the full impact of a decision, of a resolution. So, as I've indicated, it could be that the trustees are now required in some cases to pass written resolutions rather than just by show of hands putting up taking a decision. It could also be that a number of decisions which were previously the ambit or within the competence of the trustees have been removed from the trustees and are now passed across for the approval of the owners in general meeting by way of some kind of resolution, generally a special resolution. An important one of probably the biggest change that came about in 2016, as I've indicated, is the split of the funding of bodies corporates into administrative and reserve funds. It's important in the sense, and the legislator considered this important enough to put it in a regulation which cannot be altered by the body corporate, and the regulation lays down the amount of money that must be raised annually by the body corporate to provide for the future funding of the maintenance, repair and replacements in the body corporate. For instance, if there are no reserves, and these reserves are determined in relation to the administrative fund, which is the general running of the scheme other than maintenance, repairs and replacements. If the amount of money in the reserve fund at the end of the previous financial year, so there is a requirement for a previous financial statement. If the requirement is less, than 25% of the contributions to the administrative fund, then the money that must be raised for the coming year must be at least 15% of the budget for the administrative fund for the year to come. So there are 3 cases. There is if the amount of money in the reserve fund is less than 25% of the contributions to the fund. If the amount of money is between 25 and 100% of the contributions to the administrative fund in the previous year, or if the money in the reserve fund is greater than or equal to the amount of money of the contributions to the reserve fund. Perhaps we can discuss this at the end of the session. I just want to try and get back to the maintenance, just quickly run through the remaining slides, and then we can get back to the reserve fund. Auditors, annual financial statements. Oops, I'm going the wrong way. Referring to what I said earlier, what was introduced in 2016 are some injunctions, what the body corporate must not do. And that entails making loans without to making loans from body corporate funds without the authority of a unanimous resolution, refunding levies which were properly levied, and distributing funds other than upon destruction of buildings or in the case of capital nature. Here are some trustee activities which require written trustee resolutions. Where these were previously passed by way of ordinary resolutions, the new rules require that these be taken by special resolution. There's quite a long list of them, but this is the wording from the rules, so you'll be able to read these in your own time. Okay, I just want to see. Okay. I'm going to leave it at that. I don't know whether Muneer is now in contact, whether we can now maybe take questions.
David,
Muneer?
I'm not sure if you can hear me, but I've managed to come into the session.
Okay, I can hear you, Muneer. I can see you. Hi, we haven't spoken for quite a while.
It's been a while, yes.
Yeah. Stan, Danny, how do you want to do this? Do you want to take some questions, or should we let Muneer?
I think let's let Muneer start.
Let Muneer start,
can,
and we can come back after he's finished his session. I can then deal with questions and one or two other issues.
Yeah, would you like to have a break in between after an hour? Or you want to go right?
Yeah, it's where are we now? It's 1:45. Do you want to take the break now, or let Muneer go for a few minutes and then take the break?
I think let's start with Muneer.
Okay.
And then I think Muneer, you will want to break at 3, or how you feel. You'll let us know how you feel.
No, perfectly. I think I'm going to try and break the lecture up into 2 parts. So I'd like to actually break it 5 minutes in between the 2. But if you're happy for me to start, let's get going. Yeah, and then an hour later, we can basically do a break. We can then do the second session, and maybe at the end, we can do all questions between both David's and my session as well. We can wrap around the questions itself, and people can digest the information as well.
Okay, okay. So Muneer Hassan, lecturer in accounting, and the floor is yours. Take it away.
Thanks.
Okay,
So, David, are you going to stop sharing so that I can share for
yeah,
myself?
I can. Let me.
I'm going to go help David. Hold on.
Okay.
Just go here.
Okay. Stop share.
Yeah.
Okay. Oops. Hang on. I've still got my picture here. How do I?
No, this is now going to Muneer's side.
Okay. Okay.
You can stop the video if you want.
Stop video. Okay.
And then just mute.
Mute.
Okay, perfect. I hope you can all see here clearly. I'm just checking on your side, Stan. David, you're all good. You can see, you can hear, you can see my slides.
Yeah, we can see you.
Perfect. Okay, so we are going to kick off. I'm going to quickly do an introduction because the last time I actually presented to this forum, I think I still stood up in the War Museum, and things were very different, where we could have a conversation face to face. And since then, you know, I've been hounded by Danny to actually come and do a lecture, but my busy schedule has overtaken my life seriously. And finally, I've made it to actually do the session. And I've been meaning to come back to do the session at this platform itself. And thank you again to Danny for employing me. It's just those that don't know me, I've been in tax for about 20 years now. I've basically spent 7 years. I worked for SARS. I spent 7 years as head of tax at SAICA. Most of you would remember me from there. And the last 6 years I've been in academia. I've actually this morning presented to the committee to actually, and I've been registered as of today for a PhD in tax. And one day I'll come back and maybe tell you about my PhD, but it's an exciting new chapter of my life where I'm going to basically look at the value-added tax and particularly look at simplification in the VAT Act. And I think it will be a welcome relief if SARS listens to that plea from my side as well. So today we're going to kick off, we're going to deal with a difficult section, but we're going to make a little bit of fun in it, keep it lighthearted, and we're also going to make sure that you learn the rules and you try and remember those as well. It's particularly relevant in the market space. The last time I took a walk, I don't know who goes to restaurants or who actually go to malls nowadays, but I took a walk to our mall not so long ago, and I was astounded to see the number of restaurants that I used to eat at that is just closed down, they're just gone. And, the sections, and we're going to talk about the tax effects and the sections that come into play, and the possible income tax implications that come into play as well when a business basically closes its doors, like a restaurant itself. It's going to have possible tax effects and sometimes adverse tax effects, I might add. So very prevalent as well. We're going to also go through a small question that appeared in SAICA's April ITC, just to show that even SAICA has actually tested this as late as in the April ITC, the ITC that just took place a couple of months ago. So the issues that we're dealing with today are extremely relevant and both prevalent in the market space. When you write off a debt, it will hold tax implications both for the debtor as well as the creditor itself. And Danny, I'm going to ask you to do a quick poll question for me and to put up the code poll to see what my audience think about it. So the question that we basically asking is that if a company basically uses its bank overdraft credit facility to pay operating costs, which are all tax deductible, and since COVID-19 now hits, like you can imagine, the restaurant businesses, their sales are little to nothing. And the company has obviously committed continued expenditure itself. And the question is, will there be tax implications for the company if the bank writes off the outstanding loan effect itself? So they've got outstanding liability to the bank itself. Will there be an outstanding liability? The possible answers are basically yes, no, or maybe like a politician. So maybe you can answer like a politician as well and say, I think so. So then how's the panel votes looking? And it's just an icebreaker question to get the show going.
People are starting to vote. It is anonymous, so don't worry. I've made all the questions. There's no
perfect.
need to feel embarrassed if you.
So maybe you want to chew on that. So think about it. Give
it a minute. We've halfway.
Okay.
Half of the people have voted so far, so we'll give him another minute.
Okay, perfect. So think about it, guys. Think of a normal restaurant business itself. I mean, it's very prevalent. They basically, under lockdown restrictions, there's no sales coming into the business itself. But your fixed costs, your operating costs, your rental income, your rental expenses, you've got to pay those stuff. You can't stop paying it. And remember, those are tax deductible costs itself. And if they continue to incur expenses itself, and the bank, a third party like a bank, is basically funding those tax deductible expenditure, one day when the bank writes off that loan, because when you close shop, you're going to close the restaurant down, the bank is going to walk away from their asset that you basically owe them, which is the loan account. When they write that off, what is going to be the implication then in the hands of the company that got this past deductions itself? Is there going to be potential tax implications? And is it a maybe, a yes? Is it no? Will SARS walk away from that and say, you've got past deductions, allowances, we're not going to worry about that? Or is it a maybe, you think that possibly there could be a tax implication, but you're unsure of that? So then if you can let me know how the votes are coming in then.
So we had about at least half have voted. So I'm going to give 5 more seconds if you're voting. So 5, 4, 3, 2, 1.
You can vote. I'm not going to take your CASA away from you. You're so safe, you know. So, and it's all anonymous, so we don't know who's voting actually. Okay, so and I like that because a lot of the participants, and I'm sure you can see the results itself, is a lot of people are saying, yes, there's some kind of tax implication. You know, SARS is a stubborn bugger out there. They're not going to walk away from funding your tax deductions if you haven't paid for that expense. Listen to what actually has happened, is that technically you've paid for expenditure, or if you've incurred expenditure and you got tax deductions, but ultimately you did not have to pay for that expense itself. And what SARS is going to do, we're going to see that, is that's going to trigger possible tax implications in the way of a recoupment that's going to come and bite you. It's going to come back and bite you itself. And I see a lot of people, 12% of my audience said no. And then there's some politicians, 6% said probably maybe that could come about. So that's just the sort of icebreaker question to get it going. So when there's a debt that's written off, like in the example that we basically looked at, the first issue from a tax point of view I want you to do, identify the taxpayer that we're dealing with, because there are different tax implications dependent on the taxpayer that we're dealing with. So if it is a debtor, we're going to basically have certain tax effects. And if it is a creditor, then we're going to have different tax effects. So in our example that we just done, the party that actually the restaurant business was the debtor company. This is a company that took loan funding from the bank, and they basically used that money to pay some of the expenses, fixed costs that they needed to pay. And they needed to basically pay the bank back money one day. So they are the debtor in our example itself. And we're going to look firstly at what are the implications in the hands of this restaurant company when they close doors and they shut down and they can't pay the bank. And secondly, we're going to then take a pause. That's when we'll do the break, hopefully, and we'll come back and we'll focus our attention. Then we'll flip to the creditor side and we'll say, okay, so what's the implications then in the hands of the creditor? That's typically the bank company in our example. So let's have a look. Broadly, the principle, if you take nothing away from this afternoon's discussions, please take away the principle so that you can at least identify that there's a need to call in a tax specialist because something is happening over there. There's potential tax implications that you can see coming as you're basically dealing with your audits, as you're basically dealing with your accounting of the transactions itself, and you see this debt's been written off. You should know enough. I'm giving you the sort of the trigger just to alert you that even if you take nothing back this afternoon, take this back, the principle, the big picture principle itself, so that as you're accounting, as you're auditing, you can pick up the issues in a live transaction. So SARS principle, think about it, is to reverse past benefits because the debtor does not have to pay anymore. And what is this past benefits? It is past tax deductions that the debtor company got. And they're going to limit any future benefits that funded possible. For example, you could have bought an allowance asset. So you're going to get future tax allowances on that asset itself. And what SARS is going to do is they're going to block that future benefits. So think about it. When you incur, think and go back to what we learned in varsity days. When do you claim a deduction for income tax? We start off with what? The general deduction formula. And that says expenditure and losses actually incurred in the production of income, not of a capital nature. We all know that, right? Now, where in that section, I asked you, where in the section does it say that for you to get a deduction, it must be paid? Nowhere it says that it actually needs to be paid. It talks about incurred. The expenditure must be incurred. If it is paid, it has been incurred. We know that. But nowhere it actually asks you for you to get the deduction that you must physically pay for that expense. And because of Section 11A and the way it has been drafted, obviously, as you incur an expenditure, you actually getting the deductions, you're getting the income tax deductions. As you buy an asset itself, also, you don't have to pay for the asset. You just have to own the asset, and the allowance sections kick in, and you start claim allowances provided that you use the asset in the production of income. Nowhere it's talking about payment. But here's the point. If you do not pay, if you do not have to pay for that, it's going to come back and bite you. And what SARS is typically doing from a principle and policy point of view is they're coming back after the effect and saying, hang on, you did not have to pay for this expense. You did not have to pay for the asset. We're going to recoup that past tax benefits and allowances that you basically got. So if you take, like I said, nothing away from my lecture today, please take that word, because that's going to help you to trigger the fact that there are some tax implications that are brewing when you're basically doing your audits, when you're basically accounting for transactions. So as we start with any section, it starts with some scope and implications. The first thing that we basically have, or the sections that we need to look at, is basically section 19. That's in the Income Tax Act, and paragraph 12 cap A, which sits in the 8th schedule. Now, it is written in a rather complex way as well. It almost feels like I'm back to the VAT and my issue on VAT as well, because, you know, the legislation is drafted in a very difficult way. If you try and go and unpack these issues, you probably spend, like I did, a week on it just to understand the interaction between section 19 and paragraph 12A. But we're going to simplify it for you, and we're going to make it easy for you to actually take away something from the session itself. So if you look at the scope, both in section 19 and paragraph 12A, it says that we need a debt benefit. So the scope is basically, we need to tick this stuff. We need to say these stuff are here. If we tick it, then we're falling into the scope of the section, and we've got a possible implication that's going to hit us. So what's the scope? We need a debt benefit in the respect of a debt itself as a result of a concession or compromise which directly or indirectly funded that debt. Now, those are big words, and that's a lot to chew on, isn't it? Right? So don't worry about that, because what we're going to now do is we're going to unpack those words. We're going to basically debrief those words, and we're going to try and look into each word to understand what is it that SARS is actually trying to achieve there. Before we go into the unpacking of the words, I want to do another quick poll, Danny. And the question here I'm going to be asking is where alone, now think about this here, is that we are dealing with the entity that took loan funding. And if I take money from you, you're the guy that's got money, you gave me loan funding. I take your money, I take your loans, and I can't pay you. And this is quite common in the practice in the market space. I've seen a lot of transactions of this nature. What I now do is I say, you know what I'm going to do? I'm going to convert that loan account basically into shares, because I can't pay you. I'm being honest with you. I can't pay you. So what I'm going to do is I'm going to convert the loan into shares, but I'm going to give you less than market value shares. And obviously there's some kind of benefit that I've received, because let's assume that the loan account is R1 million. And I'm telling you, you know what, I'm only going to give you 800 Rand, 800,000 worth of shares. So I've definitely received some kind of benefit, and my benefit in this example is 200,000 itself. Now the question is, will that benefit that I got, do you think it will trigger recoupment on the interest in the data company? Or is it actually, it doesn't matter? Because remember that loan account is a mix of things, isn't it? And it's a mix of two things. It's capital and interest itself. Now, when we converted loan account into share capital and we calculated the 200,000 benefit that I got, my question to you is, will it catch? Is it going to trigger a recoupment of anything that I've done with your capital money and I applied it to past deductions as well? Or is it only worried about interest itself? Is it only going to trigger the interest component? And what do you think? Am I only going to have a recoupment on interest, or am I going to have a recoupment on anything that you applied that 200,000 benefit in regard to? So whether it's capital or whether it's interest, it doesn't matter. So that's the question, Danny. How's the votes coming in on your side?
So far we got quarter have voted. Okay, people are voting more now. So let's give them another few seconds. We're nearly halfway through.
And it is a difficult question because if you haven't worked through the detail, and it's just an icebreaker again, I just want to gather my audience to see, if you're on top of the issue or not. If not, then it will also inform me how slow or fast to pick up the pace on the lecture itself. Okay, so how's it looking, Danny?
People are still voting. I see still a few numbers coming in. We're over halfway now, at least. So
okay,
let's give it 5, 4. Okay, let's
see what the results look like. Okay, so sure, there's like a split class here. There's like a 49% said true and a 50% said false, because the question that I asked is that when you convert a loan into share capital and there is a death benefit that we calculate, it is only going to trigger the interest in the hands of the debtor as a recoupment. So it's not going to worry about capital itself. And the actual answer is 49%, and I can see it's a split, it's a tight vote here. 49% said true, but that is the answer. And the reason, guys, for that, think about it, right? When you basically invest in a company itself, it's share capital, right? When I put money into your company, you take my money and you take that money and you basically apply it in any way, shape, or form. You can buy assets, you can pay salaries and wages, you can get, in other words, as a tax person, I'm talking to you, you can use that money to get tax deductions itself. So SARS technically is saying, when you take a loan and you convert it into shares and there is some kind of a benefit that can be calculated, we are not worried about capital. We are not interested in the capital component, even if the company took that capital and funded previous tax deductions or assets or allowance assets itself. They are only worried about interest. Why? Because interest they'll never forgive, you know that, right? Because in all probability, the debtor company would have claimed the interest as a deduction under Section 24J. We've got a special section that basically sorts out and deals with interest over there. And that's principally what this is basically, or the policy thinking, I shall say, with regard to why when you convert a loan into share capital, SARS will only attack an interest-bearing loan, and only to the extent that the interest has been written off, basically. That's what they are worried about. So with that said, we're going to basically look at a quick, we're going to pick up again with the definitions we spoke about. We're still unpacking those definitions. So what is a death benefit? Death benefit in our example that we've done, that is what we're actually calculating. So we compared the 1 million to the share capital that I gave you, and what benefit did I get? I did not have to pay you 200,000. So that's the number generally that we are trying to basically calculate over there, right? What is a debt? A debt includes any debt, so it's a wide definition. I think we all know what debts are. I owe you money. There's going to be a debt itself. Anything that's linked to a payment arrangement is going to be a debt, but it excludes a tax debt. Now, what does that mean? That simply means that if you go into a settlement arrangement, back in my days, I know we used to do quite a lot of settlement agreements. You'll remember, if you're old enough like me, we used to do settlement arrangements with taxpayers. So where they basically write off a tax debt, all this is saying is that if you owed SARS money and you entered into a settlement arrangement with SARS, then the sections are not going to apply to you. That's simply what this is saying, is because the whole deal is basically with SARS, and it is SARS themselves that are going to trigger a possible income tax implication as well. So then we look at this big word of concession or compromise itself. And the question then is, what is this concession or compromise? So concession or compromise, listen to the language used, is any debt that is cancelled or waived anything that is extinguished by redemption or merger. Now watch out for that one. I've recently seen where there was a company that was taken over, and what they done is they basically, as a result of taking over the company, the agreement stated that the debts will be wiped out. And that's an example of an extinguished debt itself by redemption or merger or takeover or by a company itself. So be careful when you're analyzing contracts itself. I had to give an opinion recently on one live transaction that was dealing exactly with this issue, that there was a merger, there was actually a takeover happening, and part of the agreement said, well, we are extinguishing. Part of the agreement was that liabilities, the creditors are going to walk away from their liabilities, meaning they're going to basically be extinguished on acquisition of the company. That's going to be read into a concession or compromise, and there's going to be possible tax implication in the company that you're basically buying. So watch out for that as well. And then the one we dealt with, a loan that is then converted into shares. Remember, it is only interest-bearing loans that we're basically interested in, as I've basically explained in my example, that we will not. So if it is a capital, a non-interest-bearing loan arrangement that's converted into share capital, even if it's less than market value, we're like not worried about that. We are worried when there is an interest-bearing loan arrangement. So I think Musa has asked, what if the loan was interest-free to the company? So, you know, that's typically what would basically happen, is that what will happen is that it will not be applicable. It is only applicable if we're basically dealing with a interest-free, interest-bearing loan accounts. Then Herbert has asked, would there not be a capital gain for the debtor company? So Herbert, your thinking is right, but remember, the capital, there won't be a capital gain, right? But rather what's going to happen technically, just I want you to think about this, because we're going to come to this, is that technically the other party, the creditor company is going to get a capital loss, right? So what's going to happen with this party, there is going to be potentially either a capital gain, something must happen. Your thinking is right. Some tax implication must happen. And we're going to actually unpack what the tax implication is in the hands of the debtor company. So I like your thinking, and I like the fact that you're thinking that something must happen, but possibly a capital gain or something, but we'll look at it. Right. Now, coming back, section 19 and para 12A applies to directly and indirectly funded debt. Now, what do we mean by that? Let me give you an example of directly funded debt. That's also, SARS has explained this in their comprehensive, I'm not sure if you've seen, but there's a 100-page document on section 19 and para 12A. It's issued for draft comment at the moment in the market space, and they basically commented on what they see as directly and indirectly funded debt. So it's not my views, this is SARS views, right, that I'm portraying. So directly funded debt is basically where, for example, you buy trading stock from a company and you have an inability to pay the company, you know, difficult trading conditions. SARS says no trading, no sales can happen under COVID-19. So you can't pay the debt, and ultimately your creditor writes off the debt and say, I'm forgiving the debt itself because of your inability to pay. So that's an example of a directly funded debt, because I bought trading stock, I have an asset from you on one side, but I also owe you a liability, I owe you money basically. So I treat you as a creditor. There's a creditor sitting you on my balance sheet. So I have you as a creditor. And now I can't pay you in relation to the stock I bought from you. That's directly funded debt. Indirectly funded debt, an example of that would be, for example, where you go to a shop and you want to buy trading stock, or a retailer, and they are like, no, you know, I don't give credit. My terms are cash only. You're probably dealing with the Indian in this case. Right, so you buy the stock, you want the stock, and they're saying cash only deals, no credit terms itself, but you need a trading stock from this guy himself. So what you do is you go to a third party like a bank, and you take a loan, and you walk into the shop now and you pay for the stock. You bought a trading stock and you are sorted. You got your trading stock, but come months later, and your business needs to be shut down, and you can't basically trade no more, and you get into financial distress. And now you can't repay the third party, for example, the bank in our example. And the bank writes off that loan. that is an example of an indirectly funded debt. Can you see that? It indirectly funded the trading stock acquisition. That's what it done. And you still got a deduction for the trading stock. And therefore, what Csos is saying is that when that happens too, it's going to be pulled into scope for Section 19 and paragraph 8 purposes itself. So I hope that makes sense. All this is saying is that be careful whether it is directly or indirectly funded debt. Paragraph 12A and Section 19 can still find its way into being applicable itself. And you know the way legislation is drafted is that generally we have the scope, and part of the scope I always say is the exclusion. So when does it apply and when does it not apply? And then we have the implication. So now we're into exclusions, which for me is still part of the scope itself. So in the following cases, Section 19 and 12A is not applicable, and I've really tried to summarize it for you. So the first instance, and I want you to take, if you take again nothing away from this slide, take one thing away from the slide, is that if there are other tax implications, then generally there shouldn't also be a debt waiver implication in the hands of the debtor, right? So for example, if the debt is owed to an heir in a deceased estate, now you guys know that when you have a deceased estate, any debt owed to that person, the deceased person, is caught into property, and you're going to pay estate duty on that. That's part of your estate duty calculation. If the executor writes off the debt itself, we are not worried about it because, why? The deceased has already paid 20% estate duty on it. So there's already been a tax implication in the hands of the estate itself. And therefore, when that debt is basically then written off, it's not going to have further tax implications itself. A secondary example is, for example, a donation. Now, a donation, as you guys know, is gratuitous in nature, no strings attached. I'm basically, out of the goodness of my heart, coming in and saying, you don't have to pay me. Then what's going to happen is that the donor is going to pay donations tax of 20%. Can we see the same thing, 20 or 25%? The same thing happening is that whether there are estate duty implications or other donations tax implications, you as the debtor are going to walk away free and you're not going to have further tax implications itself. Another example is an employee debt. We know the reason for the exclusion is because you know that employee debts are possibly going to have some kind of fringe benefit tax implications itself, and therefore there's not going to be debt waiver implications in the hands of the debtor itself. And then the other one, you guys know this, the way the Act is built is that generally intergroup debt, because we don't have group tax in South Africa, it's something that we've spoken about quite a lot about, because we don't tax groups as a whole, as a group taxation. For example, in the US, they do that, but we don't do that here in South Africa. What happens is that within each section, we give intergroup relief. Can you see that? There's intergroup relief coming through over there. And we see all this, that if something happens between a tightly held group, we're not going to have tax implications. Why? Simply because on the one side, it's an in, on the other side, it's an out. I mean, the earlier question that was asked to me, on the one side, there's going to be a capital loss. And on the other side, we said potentially, you said a capital gain or some kind of other tax implication. But technically, within two group companies, it's an in and out. So the one side is positive, the one side is negative, and Csos then doesn't worry about that. Then the third big issue that we look at is, or the exclusion, and we dealt with this one, by the way, so you should pick it up, is that it is not applicable to non-interest bearing loan conversion. That was a question that I got on the chat line also earlier, i.e. it does not apply to capital or non. And then another further exclusion only for paragraph 12A is that if you're going to wind up, liquidate, or deregister the company, it's not going to be applicable. Quite logical. I mean, if the company is already dead, it's going to be closed down. What is Csos going to get out of this company? These guys can't even pay the debts. How are they going to pay Csos if you're going to impute further tax implications in the hands of the company that's about to be shut? So obviously, if ultimately the company is going to be shut down, we're not going to have any further tax implications. Then I'm going to work with this example together with you It's an example, like I said, that we basically, it popped into the Csos ITC now as latest as April ITC, and it's something that we've just been through. So it deals with the loan, basically that's going to be converted into share capital itself, and we're going to work through the example and to just make sure that you understand the loan conversions and the fact that how these issues basically translate. So we've got a company over here, Jody, and it's an ice cream manufacturer. It sells bulk wholesale to all its income is derived from ice cream sales itself. So it's an ice cream manufacturer or retailer itself. They're a South African resident company. That's important for me, and that's important information for tax guys. That tells me that their tax year end is December. That's a good something that you want to actually make note of. So Jody was considered to be a small business corporation as defined in 12E. What does that tell me? That simply tells me that they meet the requirements of 12E. They're going to get accelerated allowances. If it's manufacturing assets, you guys know you claim 100%. It's very good to be in this regime because even the tax rate is better. You get a special nice tax rate, which is not going to be taxed at 28%, but rather a nice small little sliding scale. Jody is a sole shareholder of the company itself, and he contributed 8 million, and he acquired all shares in the company itself. So we've got a shareholding, natural person owning all the shares in the company itself, and it's a normal PTY company. It's a private company itself, and we can see because of that also why it's actually meeting the requirements of 12E itself. Jody then purchased, here's a transaction now coming. Right, identify the transaction. They purchase an industrial freezer, 1 million excluding VAT, and it is brought into use on 15 October 2019. Now, what does that tell you? Immediately, I just told you earlier, when a company that qualifies for Section 12E claims an allowance or buys a manufacturing asset, they're entitled to 100% of the write-off in year one. That's a fantastic tax allowance, isn't it? You get the full write-off one shot. The purchase was financed by means of a credit facility, and that was obtained from a company known as Commercial Asset Finances. We'll call them CAF. Right? So that's important because technically, when I bought this asset, expenditure and losses, I first go to Section 11A. It says not of a capital nature. I'm not worried. I then immediately go into Section 12E. Section 12E says, if it's a manufacturing asset, I give you 100% of the allowance as long as it's incurred and is brought into use. So I get immediately a tax write-off of 1 million in year one, even though I did not pay for it, because I basically still owe, this is bought on credit. And the terms and the conditions are as follows. The credit facilities bear interest at a rate of 12%. So it's an interest-bearing loan. What are we seeing? We've seen that the loan is interest-bearing. Interest is calculated and paid at the end of each month. So it seems like if we keep up to terms with the payment interest arrangements, we have to pay each month. It's not like I can allow that to accumulate. And the principal is only payable by 14 October 2024. So it's quite a long, we can see we've got a couple of years still to actually go on. It's almost like a 5-year payment arrangement over there. Then they tell us that CAF is a financial institution that provides finance to small, medium-sized enterprise, and their operating model is to support risky ventures. They have previously listened to this, converted debt into equity for its clients where necessary. That's important. So that's loans converted into shares. That's what they're basically saying. And what did we learn this afternoon? We learned that if you convert a loan into equity and there's a debt benefit, for me, the company that's doing this loan conversion, that is going to bring into implication Section 19 and paragraph 12A. And they tell us that CAF and Jody are not connected persons. So that's going to rule out the possibility of what intergroup non-application rules when it comes to the debt waivers. So immediately I'm seeing that my intergroup relief is not going to save me because it's ruled out. Jody claimed the full cost of the freezer as an allowance in terms of Section 12E in the 2019 year of assessment. We know that. We just said that if it's a 12E business, they're going to basically be entitled to the full allowance. Then they tell us that they did not currently have the necessary funds to purchase a new packaging equipment that's required and will therefore need to obtain even further finance. So they need more money, these guys. They want to buy another machine as well. And the CFO negotiated the following proposals with CAF. The first thing he says is the existing loan of 1 million with CAF will be converted into equity by Jody, issuing 200,000 ordinary shares for a 20% interest in the company. So it's almost like the mafia here, isn't it? You know what happens is that if you can't pay the loans, they come and take you over, isn't it? And I've been saying this about the country as well. We continue taking loan funding from the IMF. It doesn't come, it comes with strings attached. It doesn't come with no strings attached. If you can't pay and service the debt, it's a problem. They're going to come and take over the controlling. And this is exactly what happens in a company situation. It's like I say, if you don't pay people, it becomes a mafia and they come and take over your company. So what happens here? They could not pay these guys R1 million and they said, hang on, I'm not worried about my R1 million. I'll come take over your company. I want 20% interest in your company itself. And I said, look, I'll give you 20% interest in my company. I'll give you 200 ordinary shares in the company because I'm in dire straits at the moment. I can't pay your loan funding. This share issue will be the full, and those are important words, full and final settlement of the existing loan account itself. And very importantly, that is not done gratuitously. It is done basically because this company is in financial distress and experiencing some liquidity problems. So there's no donations tax that's going to be applicable. Therefore, what it's saying is that there are going to be other tax implications. The market value per share in Jody would be then 4,000 for the purposes of the conversion, loan conversion. And this would also be the market value immediately after the conversion. So we're giving you, we're giving the CAF guys, we're giving them 200 ordinary shares worth 4,000 rand. So we can immediately see that's going to be less than R1 million itself. And they tell us the CAF will provide a further loan of 1.3 million now to fund the purchase of that new machine that we basically want to buy. So they're saying, look, if you want more money and you are experiencing difficulty, first convert my loan into shares in your company, then I'll give you more money and you can take that more additional funding and go and buy your new equipment itself and try and turn the company around. And Saika then asked for a couple of marks, you can see it was quite big, 17 marks. What are the normal tax consequences would be for Jody if they opt to convert the existing loan from CAF into 200 ordinary shares? And further, they also asked then whether the normal tax consequences would change for Jody if the existing loan from CAF was actually written off instead of now being converted into shares itself. And let's work through the solution together and have a look at what the solution, the standard solution map like. So the first question, which talks about the loan being converted into shares, the first issue that's going to happen, obviously, is that because you got a non-natural person, because CAF was not, it's a company. CAF is a company itself, it's not a natural person. Remember, Jody was a person holding all the shares 100% in the company itself, and that simply meant that we met the requirements of 12E. Now, if you're going to convert loans into shares and you get in another company owning shares in another company, that is going to blow you out of the water for 12E purposes, and you're going to lose your 12E. So a big issue that came into consideration is that this company is going to immediately lose its small business corporation accelerated tax rate. They're no more going to be taxed at 28%. They're going to actually be, they're no more going to be taxed at the preferential rate for small business companies. Rather, we're going to now tax them at 28% itself. And also that new packaging equipment that's going to be bought, you're not going to get 100% allowance. You're going to possibly get the Section 12C 40-20-20 allowances that's going to basically come through. Then let's deal with that issue where they converted loans into capital. That is basically a concession, a compromise. We tested it against the Act itself, and it is respect of a debt, a loan that are owed. And therefore, we're going to have to calculate what the debt benefit. And the debt benefit is the face value of the loan as compared to the market value of the shares that are issued. And what was the loan account? It was 1 million, and we issued how much? We issued 800,000 of shares, and therefore the benefit that I got in this loan conversion is that they did not have to pay you 200,000 rand. Now the issue is what happens when they did not have to pay you 200,000 rand? Is that going to trigger any tax implications? The issue here is that because the debt being converted into capital is only capital, there was no interest. Remember, one of the fundamental requirements of that settlement agreement was that I have to actually pay all the interest on a monthly basis. So interest was paid. It is only the capital that was basically being converted. So if you're only converting the capital, that will technically mean that we're not going to have any tax implications that's going to come through at all. It's not going to trigger any recoupment in the hands of the company itself. The only thing that will change is, listen to this, is Jody's contributed tax capital is now going to basically increase then by 800,000 Rand itself. Okay, so that's something that you need to make note of. Obviously, that's a term that we worry about, and it's only applicable for tax people. It's not the same term that you guys use in accounting, obviously. So that's what happens, and let's have a look at what's going to happen if we did not convert the loans into shares, but instead now the company have said, I'm going to write off that loan. I'm actually not going to worry about that. I'm going to write off the loans. I'm not going to convert it into shares. Again, if we test it, we have a debt written off. That's a concession, a compromise, all happiness. It's in the relation of a debt benefit itself. We need to calculate the debt benefit. What's the debt benefit? It's the amount cancel or waived. The whole R1 million is basically waived and canceled. And here's the thing, the question that was asked to me earlier on the chat line. Remember, you asked, could there be possible capital gains tax implications? Well, because this loan funded a capital asset in this example, it funded the acquisition of that initial industrial freezer, right? And that industrial freezer is still on hand. Technically, we have, and I like your thinking, because we have base costs still on hand. So what we're going to do, we are going to reduce the base cost by the debt benefit of R1 million. So can you see what we are basically doing? Is we are blocking, therefore, any future allowances that you may claim on the asset, because we're taking your base cost down to zero. And you say, technically, listen how logical it is. You paid nothing for this. So your new cost is what? Zero. If you sell this one day, you're going to make a full capital gain on this thing here. Then they're also saying, hang on, however, the industrial freezer, we know this, was fully written off. These guys got 100% allowance or deduction in the 2019 year of assessment, full 1 million bang. Therefore, the debt benefit of 1 million must now be treated as a recoupment, and we're going to tax the company itself on this recoupment itself. And this recoupment is now going to be included in gross income for Jody, even though they're in financial distress, and they're going to have to pay income tax at 28% on that R1 million. Why? Because previously they would have gotten a loss of deductions, or that would have contributed to their assessed loss if they were making losses. So they're going to try and reverse that position itself. So I hope that makes sense. And I think that's very practical as well in the market space. As I've said, it is extremely practical currently in the market. We see a lot of these things happening where debts are being written off, or either we're going to basically convert that into loan itself in loans. So then I'm going to basically now come back to lecturing again. We've done an example. Let's go back to some principles again before we basically can look at examples again, just that we give ourselves a break as well. So when there's an inability to pay, let's look at the grid. And this is the, and you have decided that, you know what, I'm now dealing with the implications in the hand of the debtor. I see inability to pay and a debt being written off. I know there's no donations tax going to be applicable, and I know something is happening in the hands of the debtor. Let's look at the formal principles and that you should be following to establish the income tax implications then in the hand of the debtor. The first question, ask yourself, what did you do with that money that you took as loan funding? If you have basically applied it for non-deductible expenditure, then that write-off is going to have no effect. That's quite simple from a policy point of view. If you've got no deductions, for example, you pay the bribe or penalty or fine. Section 23 of the Income Tax Act says no deduction for you. So in that case, when the loan is written off, that funded that deduction, because you got no deduction, that's going to be no recoupment itself. However, if it funded tax deductible expenditure, for example, you took money, loan funding, and you funded salaries and wages, and you did not have to subsequently pay for that loan funding that funded salaries and wages. When that debt is written off, you're going to have a recoupment of the past deduction that you got for salaries and wages. It's going to reverse the past benefits that you got. Remember what I said in the beginning of the lecture. We said that the policy thinking is to take back your past deductions and allowances. Here's it happening. We're taking back the recoupment. And if it funded trading stock, what's going to happen? If the trading stock is on hand, the first thing we're going to do, there's an ordering of application coming through here. The first thing we're going to do is we're going to reduce the opening and the closing stock, right? Because think about it, like we said with that base cost example, if I have an asset on hand and I first reduce the base cost of that asset, what am I doing? I'm blocking any future deductions that you can get on that asset itself, any allowance or deduction. Same thing with trading stock. If you have opening or closing stock of trading stock, it means that one day when that stock leaves the business, you're going to get a deduction. So if I reduce that value, what am I doing? I'm blocking your future deduction or allowance. And even though it doesn't realize in immediate tax effect, it's blocking a future tax implication or allowance you would have actually claimed. And then what I'm going to do, second order of application, is that if you've written down the trading stock, you guys know this as accountants, I don't have to tell you this, that if a stock is written off, it means you previously got a deduction or write-off for the trading stock. And therefore, if you did that and there's a debt benefit, we are going to recoup that write-down in trading stock. And the last thing we're going to do is if the asset, that trading stock, that the debt funded is already gone, it's left, it's sold, that means you got a deduction allowances, and therefore we're going to have a further recoupment on this. So I think this one is very easy. That one is easy, you can sort out, but this one is getting a bit tricky, isn't it, in terms of the order of application. So let's do one example on trading stock quickly so that you can understand how the numbers actually flow. So in our example here, we've got company A. Company A sells trading stock to company B, right? And they got a fair BAN that's important for us. And the trading stock is 300,000. They sell 200,000 of the trading stock, 200,000 of their 300 is gone, and therefore the closing stock is the 100,000. And they write down the 100,000 to 60,000. That technically means that the company got a 40,000 now deduction, right? And the credit is still owed at the year end 300,000. We still can't pay in the 300,000 that funded the initial trading stock itself. And in year two, what happens? Our opening stock is going to be equal to the closing stock, isn't it? So because we wrote it down to 60,000, we now have opening stock coming forward as 60,000. And on 1 March, then that should be 2021, they get into financial distress. They can't pay this creditor. And then what happens is that creditor writes off the debt, the full 300,000, and says, you don't have to pay me. Now, remember, we are dealing with this grid. The order of application is first reduce opening closing stock, then the recoupment of past deductions in terms of a write-down of trading stock, and then a recoupment of trading stock that's sold. That's the order of application. So let's follow that order. What we're going to do is when we purchase the trading stock, remember we got a 300,000 deduction in year one, right? When we sell it, we're going to sell it and we're going to pay gross income on that. There's no issues, right? My closing stock is 100,000, but remember I wrote down 40,000, right? So I technically get a deduction of that write down itself. And therefore my closing stock add back now is going to be what, 60,000, isn't it? Right? The net effect on the taxable income in relation to trading stock that was purchased, not sold, is 240,000 deduction that I get basically in year one. That's what it's actually doing for me, right? Then if we basically look at what happens in the second year, that's when it's written off. The debt was now written off itself. First thing, when a debt is written off in relation to a loan that funded trading stock, step one, calculate the debt benefit. What is the debt benefit? I did not have to pay 300,000. there's my debt benefit, it's 300,000. Then what I'm going to do, because it funded trading stock, step 1, I'm going to reduce the value of opening and closing stock by 60,000. I reduce it to 0. And that means I can't get a future deduction of 60,000. I'm blocking this because my new opening stock value is now 0. Then step 2, because I previously got a deduction of 40,000. Remember when I wrote the stock down, I got a deduction of 40,000. What it's going to do is going to say recoup the write down. So we recoup it, we pay income tax on that this year. And the third thing we're going to do is any stock that was sold already and I got a deduction for, remember the stock that was basically sold, right? We basically got a deduction, so 200,000 of the stock left the business, which means I got a deduction for the 200 sitting in here. And therefore, what I'm going to do is I'm going to have a recoupment of that 200,000. So in effect, what has happened, can we see what they're trying to do is that deduction that you previously got, we are reversing it and we are now taxing it as income tax again in the following financial year. And if we do a quick recon to see what has happened, we got a debt benefit of 300,000. Remember, the net effect was 240 in and out. We had opening stock in year 1, all right, which was basically still on hand. And remember, what we're going to do is we're going to reduce that now to 0 itself. So we bring that down to 0. And technically what we have is we have the recoupment of 40 and we have the 200 coming down. And therefore, in effect, we have a 240,000 add back in year 2 itself. So quite simply, what it does quite nicely is it basically, between the 2 years, in the 1 year, you basically got a deduction coming through between the 300 and the 60,000 that's still on hand, which we were going to basically add back. So if we look at the differential, it was 240 as a deduction that I basically got over there. And the effect on the subsequent financial year or tax year is that we're going to have basically then an add back. So it's basically a balancing effect if we basically look at what we are then trying to achieve here. I'm going to just check if there's any questions, if I must take any questions now before we basically continue. Danny, I'm just having a look. So there's one, what about the debit shareholder loans in private companies and CCs? Can a debit loan account be written off as a capital loss? And what is the implication for the shareholder? I would have thought it should be a capital gain for him, or will SARS deem it a dividend? So generally, when you have a loan account that are basically due to shareholders, you are right. Obviously, the first thing that you have to test is the interest, whether there's any interest element in there. And generally, if the company is now giving a shareholder a loan, this could be seen as a possible value extraction for the non-charging of interest on that loan account itself. So the first issue you got is a potential deemed dividend on the non-charging of interest if it's a non-interest bearing loan account. And if those loan accounts are then written off, that's due to the shareholder, we're going to deal with the shareholder side. You are right, it's going to be a possible capital loss, but we're going to sort that out because capital losses between connected persons are disallowed. So we're going to deal with that in the second part of the lecture. And then in the hands of the company, because that's going to be a debt written off, we follow the same rules that I just taught you. We go back to the grid of application and we're going to basically have a look at what did they do with the shareholder loan accounts. Did they fund non-deductible expenditure, deductible expenditure, or trading stock? And depending on what it funded, when it is written down, it's going to have a possible then tax implication itself. And then I see a question, if there is a recoupment of interest, then why should a company be hit twice by reducing the value of closing stock? No, but remember that, don't confuse the two here, right? Between the two. When we had a conversion from loans into share capital, that's when we dealt with the interest itself, right? Here we are dealing with a loan that was basically funded trading stock. And listen to this, even if that loan was interest bearing, in addition to the capital that I took from your loan funding and I bought trading stock, and I'm going to recoup like we done in the example itself, for the interest, I would have got a Section 24J deduction. And therefore, if you're going to write down the whole loan as well as interest, There's going to be an implication, because if we go back to that slide, remember the question is, what did you do with that loan funding? That's what we're going to ask ourselves. And to the extent that I use the loan funding to get interest deductions over here under 24J, that's going to trigger the recoupment. To the extent I took your money and I bought trading stock, that's going to trigger these implications over here. So these are the two implications that basically come to separately between how you apply capital and loan and interest funding itself. Okay, then I see one last one that says, if a creditor advances, say 350,000, out of which the debtor settles 300,000 and uses the 50,000 for other, does it change the nature of the debt? No, it is still a debt that is outstanding. The only issue that is that we basically have now 50,000 outstanding, and if that 50,000 is written off, that will hold potential implications both in the hands of the debtor and in the hands of the creditor itself. So it's not going to change. If there's a settlement of part of the loan account, it's still a debt that we're basically dealing with. Okay, I'm just looking at time. I think I'm still going to continue a little bit. We've got about 9 minutes to go, Danny, and then we'll take the break. I think we will stop exactly after an hour to give people a little bit of a break. So I now want to deal with what happens, because remember, I could take your loan funding and I could have basically applied it to operating expenses like in the first slide. But I could also have taken your loan funding and I could have bought assets, right? Now, if I bought assets, the order of application and implication in the hands of the data company is going to be slightly different. It depends whether it's an allowance or non-allowance asset. So let's first deal with a non-allowance asset. If it's funded non-allowance assets, and you know a non-allowance assets technically, basically you get no allowances on it. That's why we call it a non-allowance asset. There's no tax allowances. For example, land, there's a typical example. Another example is goodwill. There's no allowances for goodwill in the Income Tax Act, and therefore it's a non-allowance asset. Therefore, if I took your loan funding and bought one of these assets, I got no allowances. When you write off that amount that I used to fund this non-allowance asset, and the allowance asset is still on hand, all I'm going to do is I'm going to reduce the base cost of that asset by the debt benefit that I basically got. Again, what we are technically doing here is we are blocking any future tax implication. So we're basically making this whole future gain capital gains itself. Can you see what we're doing? We're not going to have an immediate tax consequence by reducing your base cost, but one day when you sell that asset, if I reduce your base cost to null, that full amount proceeds is going to be capital gain for you. So I'm basically creating future tax considerations or implications for you in the future. And if you sold the asset by the time that the debt is written off, that can also practically happen. Think about it. So you actually sold the asset, but you still own the money on that asset itself. And what's going to happen then is we're going to listen to this. This is the new rules that has come into play about 2 years ago, is that we're going to recalculate the capital gain, and we're going to catch an additional capital gain as if, listen to that, as if the debt was written off before the asset was sold. So we're going to look at an example on that because it gets a little bit tricky over there. Then it could also have funded allowance assets itself. And if we funded an allowance asset and the asset is on hand, we sort of went through this in the psych example already, is that the first thing is if the asset allowance asset is on hand, we first reduce the base cost. If there's no more base costs to reduce, we're going to trigger recoupment. And lastly, what we have is because you still got the asset on hand, you are like, I can claim future allowances. But remember, if your new base cost has been reduced to null, then your future tax allowances are also going to be blocked going forward. And then lastly, what could happen practically is that the asset could actually have been sold by the time that the debt is written off. Again, what we're going to do now, because we're dealing with an allowance asset, and you guys know this, that when you sell an allowance asset, there's both a recoupment and capital gains tax implications. So we're going to now recalculate the recoupment and capital gain as if the debt took place before the asset was sold, and we're going to compare the two, and we're going to catch an additional capital gain or loss accordingly. So we'll look at one example on this just to make sure you understand it. And we're also going to just look at one short example on this part to make sure you understand that as well. So I'm looking at the time, sort of 6 minutes. And I think I've still got quite a lot. So why don't we take a break right here? at this time. I think then it's a good time to take 5 minutes break, and then we can basically start exactly at 5 minutes to 3 o'clock. We start at 3 o'clock promptly then. Okay, it's 3 o'clock. Welcome back, ladies and gentlemen. Danny, I want to just check on your side. Everything is still good. You hearing me? Can see me?
All good still on my side?
Yeah, all good.
Okay, thanks. So we're going to pick it up where we left off. Just to remind you very quickly, we're still busy with what happens when a debt now funds an allowance asset. This is the issue that we're dealing with. And we actually want to look at one example. I think you can handle this. This example was sort of the psych example, the second part that we've already dealt with. So I'm happy for you to deal with that. This one is actually quite simple. The implications are quite simple. So we are coming down sort of this avenue over here, and we are basically going to deal with the implications. What would happen when we sold the asset already that was debt funded, and subsequent to the sale now, what happens is that debt is then written off. Okay, so we're going to deal with a short example together and have a look at how it unpacks and unfolds. So a company acquired a second-hand machine for 100K. They brought it into use in the 2018 year of assessment, and the purchase was funded by a loan. Let's make it non-interest bearing for now, because we know what's going to happen with the interest. If there was interest, it will trigger recoupment, as we said, under Section 24J, the deduction would have come. And if there's a debt benefit that funded that interest itself, we're going to recoup it, right? And the machine was sold for 120K in the 2019 year of assessment. The debt is then written off in the 2020 year of assessment due to an inability to pay the loan, and the company did not make any loan repayments itself, and they have a December year end. They want us to calculate the income tax implications in respect of the 2020 year of assessment. If we simply think about what's happened, year 1, 2018, we bought the asset on loan account for 100K. Year 2, what happened? We sold the asset, right? And year 3, what happened? It got written off. So in year 2018, we bought the asset. 2019, we sold it. And 2020, we basically now couldn't pay that loan account that previously funded an asset which is already sold by the time we wrote off that loan account, or the loan account is written off. So what's going to happen? I think this is all simple. You guys can do this chalk and cheese. Obviously, what's going to happen is it's a second-hand machine that we acquired in 2018. Let's do what actually happened in 2018 for tax. We're going to claim an allowance of 20%. So we're going to have a 20% write-off in year 1. But then in 2019, because the asset is still on hand, we're going to claim an allowance of 20%. Easy. That's a normal Section 12C allowances that we are claiming. Then in 2019, what had happened is that we sold the asset. And what do we do when we sell an asset? 2 things. It's an allowance asset. Calculate the recoupment and calculate CGT. So how do we calculate the recoupment? Selling price, 120 limited to the original cost of 100, less the tax value. Now remember, the tax value was 100 minus the past allowances, which was a 20 and a 20. So my tax value is down to 60. The recoupment that I'm going to trigger on the sale is going to be 40, and I'm going to tax myself in terms of Section 84A on that. So that's gross income, guys, right? So that's going to be an income tax implication immediately. Then if we basically have a look at the capital gains tax implication, you sold an allowance asset. Remember, you're going to calculate still capital gains tax implications. Proceeds is what? 120, what you received, right? Less the recoupment, any amount of the proceeds which was already taxed under income, which is a 40. So my new proceeds for CGT purposes is going to be 80, and I'm going to less the base cost, and we know that the base cost was basically at 60, we just calculated that above, and therefore I pay capital gains of 20. So that all makes sense. It all sits quite nice and well, and that you can all do. There's nothing too difficult about that. Then what happens? Here's a tricky bit. Remember that in the next year, what had happened is we now basically, we wrote off a loan that funded an allowance asset, which is gone. It's sold already. In the last year, we sold it already. What are we going to do? We're going to recalculate the recoupment and the capital gain as if the debt took place before we sold the asset, and we're going to compare the two, and we're going to recognize an additional capital gain or recoupment. So let's have a look at it. It's a little bit tricky, but we're going to see how the numbers flow. And if we've got an example, then I think it makes it quite simple. The debt benefit 100,000. The base cost of the assets, remember what's the order of application with allowance asset? First reduce the base cost. The base cost of the asset is 60. So I'm going to take the debt benefit, first reduce my base cost and bring him down to 0. There's my future base cost going forward. The cost of the asset is now 0 for me. Then I'm going to basically recoup the past allowances are claimed. And that's the 40. That's the order of application. And what's my future allowances that I can claim on this? 0. So that's what it said. We're doing exactly what the order of application told us to do in terms of TIC-RID when a debt funded an allowance asset. First reduce the base cost, then recoup the past allowances. And what we basically have, we can see with 100,000 is that it's blocking 60,000 of future allowances and it's recouping 40. So SARS is happy that they either taking back future or blocking future deductions over here, or they're taxing you on past deductions that they've basically given you. And then what's important now at this juncture to do is to now to compare and ask yourself, how much of this 40, because remember when I sold this asset, we had an actual recoupment, guys, of 40,000 on the sale of the asset. That's because of cash flow, because I sold the asset. That's a real recoupment there that we are seeing. That's not a deemed recoupment, for example, that's triggered in the debt waiver rules. That's an actual cash flow. You got that 40. It actually really came into your fund. So that's a real number there. It's not a deemed imputed number itself. Now we are trying to ask ourselves, if we had to waive the debt first and then sell the asset, of that recoupment, how much belongs to the debt waiver and how much is because of the actual cash, because of the sale? Now remember what I told you, in terms of the ordering rules, it says calculate as if the debt was first written off and then sold. So obviously if we recoup the 40 as a deemed recoupment under the debt waive, that means that the full 40, that on the sale, the recoupment was actually 0. That's technically what it's telling me, because technically the deemed recoupment kicks in before the actual recoupment could have taken place. Therefore, the whole 40 was already recouped in terms of my ordering rules, and he caught it as a debt waiver deemed the recoupment itself. Now that, ladies and gentlemen, is very, very important to distinguish what of the 40 is actually because of the debt waive and what is because of the sale on the recoupment. And you're going to see why now in the next slide itself. Now when we calculate my capital gain, because remember capital gains is proceeds minus base cost. But remember, we first assume that the debt was written off and then we now selling the asset. So proceeds is 120. Right? Now, very importantly, the reason we have to distinguish this fundamental rule and ask ourselves how much of this 40 belongs because of a debt waive and how much is actually because of the sale of the asset. Because this here, ladies and gentlemen, is what we call a deemed recoupment, and this is an actual recoupment over here. So because this is a deemed recoupment, when we calculate proceeds, we do not reduce it by a deemed recoupment under the debt waiver rules. So we do not reduce this 120 by this 40 over here. Can you see that? That's important. That 40 will not be reduced, unlike when we originally sold the asset itself. We actually reduced it. If we look at our calculation, we reduced it by the actual recoupment when we ran that number over there. So we can actually see that 40 was basically being reduced over there quite nicely. It was because this was the actual recoupment that actually took place itself, and it was because of an actual sale of an asset itself. Whereas in our latter case, we can see now what we are doing is that we're not going to reduce it itself, and our new base cost, we just calculated in the example, there's a new base cost itself, which is really 0, and therefore the new capital gain is 120. Now we're not done. We're going to now compare the two. We're going to say, what was the actual recoupment when we sold the asset, and what was a recalculated recoupment as a result of the debt waive? And we see that both of them are 40, isn't it? In the first calculation, the actual one, it was 40. We've seen that over there. It's quite nice. It comes to as 40 over here, right? And we see when we recalculate it, it is also 40. So both of them are basically 40, isn't it? So what's the difference that we must catch an additional recoupment? Nothing. actually, what this is saying is when you sold the asset, you actually caught the full recoupment itself and you sorted it out. There's nothing more to recoup on the asset. You actually only got 40 allowance ever, and you took back that and you taxed yourself on the 40. So there's nothing more for me to come and tax you on this going forward. But in relation to the capital gain now, you initially taxed yourself when you sold the actual asset on 20 capital gain. When we recalculated it, if we look at the recalculation, that came up to 120. That said, if we had first written off the debt and then sold the asset, we would have had a capital gain of 120. And if we compare the difference, it says you need to tax yourself on an additional 100,000 in the 2020 year of assessment now. So that's going to catch an additional additional capital gain of 120K. And I can remember the earlier example in the first session, or the question, remember, the gentleman said that possibly we can have a capital gain tax implication going. Here's a capital gain tax implication that he's talking about, that we basically were talking about. So let's look at the logic again, because we've done quite a lot. Let's understand what on earth is SARS trying to achieve here. So on the one side, I'm going to do a cash recon, and on the other side, I'm going to do a tax recon. So on the cash recon, we're just going to follow the money and ask ourselves what happened. We took a loan, so I owe you 100. I took your funds and I bought the assets. Remember that, right? I took the money. Basically, when you gave me loan, I'm up 100, so I'm positive 100. I took your money and I bought an allowance asset. I'm minus 100. I went down 100. Then I took that asset, right, and I sold it for 120, and I got cash in again of 120. So the net effect is I was up plus 120, isn't it? Let's look at what tax has done. Tax said in 2018, I claimed an allowance of 20. In 2019, I claimed an allowance of 20. I still had the assets, remember? Right? In 2019, I sold that asset and it recouped. It triggered the recoupment of my past allowances. So it actually took back these two allowances and it taxed me on it. So it basically, we're back to even Stevens here. Then in 2019, when I sold the asset, I taxed myself on a capital gain of 20. And in 2020, when I reran the calculation, it told me to catch an additional capital gain of 100. So can you see what has happened? If we look at the cash flow, what has SARS done? They've taxed us on the cash flow, the net cash flow position. They've made sure that you are basically ensuring that this 100 is still going to be caught and is going to be taxed as a capital gain going forward. So I hope this makes sense. This should add some logical understanding to what SARS is trying to achieve here. They're basically balancing the books like you guys do all the time. They're basically making sure that whatever benefit you got, it was fully taxed. This 120 must be taxed, and we can see how it's taxed 20 capital gain over there and another 100 capital gain that's basically come through over there. Then I want to do another example, which gets a little bit more, so I'm stepping it up all the time, right? And I know it's late in the afternoon, maybe get a cup of coffee, but you know, we're going to deal with another example now, and we're going to spin the facts a little bit because things happen in real life, as you know. Then you'll come to me and ask me, but you know, the example you done, it's not like that. That's an easy class example. What about this? What happens if this happens? So what we're going to do in this example is we're going to spin the facts a bit, and we're going to assume, and this is reality, guys. By the time, so we bought an asset in 1 year, same facts. We then sold the asset in year 2, but in year 3, by the time the debt is written off, 80,000 of the debt is only written off in the 2020 year of assessment because we already partly repaid the debt. Isn't it logical sense that it's not going to be the exact full amount always, like the textbooks tell us, that it's going to be the full amount of the debt that's going to be written off finally. It's going to possibly be that the reality of the fact is I will pay you what I can afford to, but the balance that's outstanding, the partly funded debt is still going to be written off, and that's the portion that's going to basically be written off. And let's have a look at an example how it's going to unpack and unfold if this happens, if this situation happens. Because the first one was the easy one, actually. Right, so we do the same thing, nothing complicated, nothing changed. In year 1, we claimed an allowance. Year 2, we claimed an allowance. No problem. It's an allowance asset. Then when we sold the asset in year 2, we said selling price limited to original costs minus the tax value, and we taxed ourselves on the recoupment. And then we said, hang on, it's an allowance asset, it's CGT. We're going to calculate CGT 120 minus the 40, 80 minus the 60, and we're going to tax ourselves obviously on the 20 over there. So nothing changed. All this is pretty much the same. No issues over there. However, here's the difference coming in. Remember, in our first example, this was 100, guys. This has gone down to 80, right? Because I paid 20. In year 3, when I write off the debt, it's only a partly funded debt that I'm writing off, because part has actually been repaid in this example now, right? So now my debt benefit is not 100. It is only 80. And the question, what is going to happen? So now again, first recalculate the recoupment and the capital gain as if the debt was first written off. So had the debt been written off on 80 and I still had the asset on hand, I would have first reduced my base cost, which was 60 at the time, and I'll take him down to 0. Then I would have basically recognized a recoupment, but note that I can only catch an additional recoupment as a result of the debt benefit here of 20. Why? Because my total debt benefit is 80. I've already used up 60 here. I only got 20 left here. So I can only catch an additional 20 as a recoupment over here. And if we add the 80 and the 60, that's the 60 and the 20, that's my 80 that I've basically come to over here. So I can't recoup more than what the debt benefit actually is. And therefore my recoupment here is basically only going to come to then a 20 over here. So in our first example, this number was actually 40. Remember that. Now the important question, ask yourself, how much, when we looked at our actual recoupment that we triggered, that 40, remember, we initially had a recoupment at 40. If I just circle back, there's a 40 actual recoupment. We are asking ourselves, how much of that 40 is because of a debt waiver and how much is because of the asset being sold, right? Now, we first have to calculate the debt waiver. So that 20 is as a result of the debt waiver. And therefore, the balance that we are recouping is as a result of the sale. Can you see that? That's how we basically map and we basically differentiate between how much belongs to the debt waived and how much of the recoupment belongs to the sale. And again, fundamentally, we need that information, guys, right? Because when we rerun the CGT calculation, we do not reduce that by this number. Why? Because we said this is not the actual recoupment. This is a deemed trigger. Remember, it's deeming a tax implication to take place on you. Whereas if I sold an asset, that's an actual tax implication itself. So when I rerun my CGT comp, I'm going to go proceeds reduced by the recoupment on the actual sale, 120 minus that number there. We're minusing that number over there, not this number over here. We cannot reduce it by this number itself. And that's going to basically give us now 100 less the base cost. That gives us the capital gain over there. So if we then have a look at the recalculation, again, remember we had a recoupment basically of 40 in year 1. Then basically in year 2, if we basically look, we have a recoupment again. We recalculated it at 20, right? But remember, 20 then belonged to the debt being waived and 20 actually belonged to because remember, we actually, when we sold the asset, we recouped everything. Again, this example is coming back to the point. There's nothing more to recoup, right? So when we recalculated my debt benefit, actually part of the 40, 20 was as a result of the debt being written off, and 20 would have been as a result of the sale of the asset. Therefore, that also gave me another 40, and the differential would have basically been 0 between the two. And when we compare the capital gain, I initially had a capital gain of 20, and now I had a capital gain of 100 in my recalculation. We see that come true, and therefore my difference is going to be 80. What it's going to do, ladies and gentlemen, that's an additional capital gain that might be caught into your income tax computation, and it will be included in the inclusion rate and then taxed under your income tax rate at 28% in the hands of the company itself. Let's again look at the recon, the cash and the tax recon. If you follow the cash in this example, remember, I took a loan of 80 technically because 20 was repaid, right? I repaid you. What was my loan? What am I up by? I'm up by actually 80 because I took 100, I repaid you 20. So cash in my bag is I'm up only 80 now. I purchased an asset for 100. I disposed of the asset of 120. So my net cash flow was 100, my impact, and that's what I gained on the asset itself. Tax-wise, I claimed an allowance in 2018, 2019. We're all happy with that. When we sold the asset, we recouped everything. We reversed the whole recoupment. We took back all your allowances already. And then what happened in 2019, when I actually sold the asset, I taxed myself on a capital gain of 20, and then an additional capital gain because of the debt being written off. And you can nicely see that that equates quite nicely, that the tax follows the cash effect on the transaction itself. So I hope that all basically makes sense for you. I've got a poll question just to check if you're awake again, to bring you back to order there. When a debt now funded an asset, so let's have a look at that. We've got a debt that funded an asset, which is sold in a year, in a tax year, and then the debt is now subsequently written off in the same tax year. Well, it will have no further tax consequences for the taxpayer. Is that true or is that basically false? So remember what I told you, and the two examples we ran together. We had year one, I bought the asset. Year two, I sold the asset. And year three, I wrote off the asset. This question is saying, what would happen if in the same tax year that I sold the asset, I wrote off the actual debt? I'm asking you, is nothing going to happen or is something going to happen? Is that statement true or is that statement basically false? And I want you to vote on that. And I'd like to see your answers on that itself. So compare this to the examples that we ran now together. Remember, in year one, we bought the asset. Year two, we sold the asset. And year three, they wrote off the debt. Now what's happening, year one, I buy the asset. Year two, I sell the asset. And year two, subsequently, they write the asset in that same tax year before I file my tax return. I'm asking you, is there going to have no tax implications? Or is there going to be some kind of tax implication? What is SARS' position on the matter? What do you think SARS is going to basically do? And then in your hands, you can advise me how the votes are basically coming in.
We've got about a quarter voted, so give them a few more minutes to flip a coin and choose an answer.
So just you want to chew on that a little bit, because think about it. It's all happening now in the very same tax year. Remember, the sale of the asset, and in the same tax year, we're basically going to write that off again. Let's have a look and see how that is going to basically be impacted. Okay, are we in? I'd like to see the answers.
I'm still waiting. I've only got okay, a few people are still voting. I've got one or two more now. Let's give it another 10 seconds for people to give an answer. Because I think people are still thinking because of all right, last 5 seconds to vote. Okay, I'm closing it off now.
Okay, so very interesting. So 24% said it's true. They're thinking like Csos Auditors here. And then 76% said it's false. So it's, to be honest, this is not an easy question, right? It was a difficult question because if you read the law only tells you to recalculate your capital gain and your recoupment and compare it when there is a debt written off in the subsequent tax year to the sale year end. So technically, there's accredited articles. There are people that have actually written about this issue to say that technically there is no implication like I think the bulk of you are saying it will have no further, well, 24% it will said will have no further tax implication. So they were basically going with that, and until SARS didn't basically come out with their draft interpretation note, and now have clarified their thinking and position, because we all thought that maybe it was a mistake in the legislation, but it isn't a mistake in the legislation. SARS intended it that from the legislation point of view to only catch it when, and the wording they wanted it only to be specific, that only if a debt is written off in that subsequent tax year that we do this compare, we rerun the calculation and compare. And in the draft interpretation note, they basically say that the reason for that is that if you're in the same tax year, remember before you've actually filed your tax return, you have not actually done your recoupment and your capital gains tax implication. And the interpretation is that when you are basically calculating your final tax, when you are filing your tax return at year end, and that's obviously going to be post year end, by that time, you know that in the same year, there was a debt waiver. Then what you're going to do is you're going to first apply the debt waiver rules, and then you're going to basically calculate the recoupment or the capital gain. It is not necessary to first calculate the capital gain recoupment and then rerun the numbers as if the debt was written off and compare itself, because technically the legislation is not doing that. So let's look at the example together. Let's try and see what SARS is trying to do here. So we've basically got company B, Feb year end, default year of assessment, no issues. And in the first year itself, what happened on 1 March year one, they obtained a loan of 2 million rand from company A, which company B used to acquire an allowance asset from a third party at a cost of 2 million. So this is one of those indirectly funded loan arrangements that we basically talked about. We bought an asset of 2 million. I took a funding from one party and I basically paid a third party that to buy that asset itself. They claimed allowance wear and tear of 10% a year, and they basically claimed it under Section 11E, and that basically amounted to 200,000. So if we take 10%, obviously, of the 2 million, that gives us nicely the wear and tear rate in the first year of assessment that are on the asset. Nothing too tricky, nothing funny about that itself. In the second year of assessment, company B now sells the allowance asset for 1.7 million. On 31 August, remember we have a December year end in year two, and they sell it to an unconnected third party. Company B then claims a further allowance of 100,000 because they probably use it only 6 months until the date of selling it. They probably ran obviously till the 31st August for the 6 month, till it actually ran for 6 months in terms of the use of the asset itself. Then basically what happens is that 2 weeks later, company A waives the debt of 2 million that is owed to company B because company B has an inability to pay. And they basically tell us that none of the exclusions apply. So no intercompany, no group relief, no donations tax is applicable. They are basically saying that section 19 and paragraph 12A is going to be applicable. Now, since the disposal of the asset and the debt arises in the same year of assessment, that's what I want you to see, is that paragraph 12A is going to apply first, and then obviously we're going to run the order of application because we've got an allowance asset on hand. Step 1, reduce the base cost. Step 2, make a recoupment of the past allowances, and then consider the limitation on your future allowances. That was the order of application that I taught you, where debt funded an allowance asset, and it all happens at the same time, even before the asset is sold or in the same year itself. The application of 12A is not prohibited since the asset was not disposed of in the prior year. The tax is an annual event. That's what SARS is saying in the interpretation, and all transactions must be considered at the end of the year of assessment. So they're saying it is not like you're first going to calculate at August itself. You're not going to, on 31 August, calculate a recoupment and a capital gain. You're going to do this actually at the end of the company's year, which is 28th of Feb. And by that time, you know that there was a debt written off in relation to this asset itself. So first apply the debt waiver rules and then calculate your recoupment of capital gain. It is not necessary to do it 2 times and compare, like in the previous examples where we've done over 2 financial year ends itself. So if we then have a look at what the result would look like, is that the debt written off was 2 million rand. That's our debt benefit. We need to start with that. You've seen in all examples, we start with 2 million itself. The debt of 2 million funded the acquisition of an allowance asset, which is not disposed of in the last year. As a result, what we're going to do is we first reduce, as I said, the base cost, and my base cost is 2 million minus the 300,000 wear and tear previously claimed. And that is firstly going to reduce my base cost to 0. The base cost is, however, limited to 1.7 since it cannot be reduced below 0. So even though my debt benefit is 2 million, the base cost cannot be reduced more than 1.7. I still have 300,000 of my debt benefit that I can utilize to take back past benefits in this example itself. Now, under Section 19.6, to the extent that the allowances was granted, which is 300,000, and the debt benefit was not applied to reduce the base cost, what is going to happen is that is basically going to trigger a recoupment of 300,000 in terms of the excess itself. And even though the amount of the debt benefit was 2 million, reduced by the 1 million, because expenditure was 300,000, which was allowed as a deduction under 11E, had been already reduced under the base cost, it will not be available again as a reduction under 12A. So simply what we are doing is we are following the order in the rules that I told you, where debt funded an allowance asset, first reduce the base cost in my example 1.7. We still have 300,000 because the 2 million was the actual debt benefit. The balance, use it to recoup past allowances, which in this example is going to be 300,000. So simply put, step 1, base cost of 1.7 taken down to 0. And secondly, we have a recoupment on the sale, a recoupment as a result of the debt benefit of 300,000 itself. Now, remember what had happened is that the asset was disposed of 6 months into the year itself. So no partial allowance. So a partial allowance was obviously claimed. So we got 100,000 as well, right? And initially, we remember we claimed 200,000 in year 1. So in total, we claimed 300,000. And that's going to obviously be my total allowance. The limitation rules under 19.7 do not limit the allowance, as a waiver only occurred after Company B was entitled to the allowance under Section 11. All that is saying is that because you still had that asset, the asset was still being used until 31 August, you cannot limit this 100,000 and stop my 100,000 from being claimed as a tax deduction, because the debt was only waived, remember, 2 weeks after the asset was actually sold, after August itself. So as at 31st August, I can still claim 6 months, which is my 100,000 of the allowance, which must come to as a allowance under Section 11E. And 19.6 is not going to stop you from getting that allowance, because that asset was only, the debt was only written off after 2 weeks after the asset was then sold itself. And then if you look at the recoupment trigger that's going to come to, while the recoupment provisions of 8.4 have application on the disposal of an allowance asset, no recoupment is going to be triggered, since the selling price of 1.7 is equal to the tax value of 1.7 itself. So we can clearly see that that's not going to trigger any further recoupment itself. Why? Because the actual debt benefit already recouped 300,000 on the debt waiver. There's nothing further to recoup on the actual sale itself. And what's going to happen is that full proceeds of 1.7 is going to be constituting a capital gain derived by the company itself. And the proceeds in this example, again, will not be reduced, very important, by the 300 debt benefit recoupment that I've explained to you, because that is a deemed recoupment. It is not an actual recoupment itself. So quite simply, we can see what has happened over here is that we firstly applying the debt waiver rules itself, and then we're calculating the recoupment of capital gain as if the asset was sold itself. And in this example, we're going to have a full capital gain of 1.7 million itself. and ultimately we're going to reduce or recoup the 300,000 itself, which is going to be a recoupment trigger. So I hope that explains the position of an example, what would happen where we basically have an asset that was basically disposed of. In the same year, we have a subsequent debt being written off into an asset, which was then written off. What we're going to simply do is we're going to first run the debt waiver order of application and then calculate the capital gain and the recoupment that results from the asset itself. So that basically is I want to give you a big thought process. We've actually come to the end of the first part, which deals with the implication in the hands of the credit debtor itself. We're going to briefly, in the last sort of 25 minutes, now switch our focus into the hands of the creditor itself. We've already unpacked all the implications in the hands of the debtor. And just from a thought process, look at the inability to pay. That's going to be your trigger itself. The moment you see that, you know there's some tax implications that's going on in the hands of the debtor itself. And then worry about your exclusion, because remember, if it's between group of companies, connected persons, if you have a donation or other tax implications, then you don't have to go through all the stuff that we just went through, because then the sections don't find application. Then obviously, if there's no exclusion that are applicable, you are basically back into scope of the section. Ask yourself, what's the debt in the respect of the concession or compromise? Calculate the debt benefit amount. Then ask yourself, did it fund an asset or expense? And accordingly, then follow the order of application the way I've basically shown you. And it maps 100% with the order of application that we basically see in the Act itself. So that the two goods that are basically given to you is a nice summary of how the order in the rules actually work in terms of that waiver rules itself. So I hope that has actually added benefit. I just want to check, Danny, if there's any questions before we step off and move into, for example, the implications now in the hands of the creditor company. I see one question Herman has asked with regard to the debt written off, which was used to claim input VAT purchases. What are the output VAT consequences? It's an interesting question, Herman. What's going to happen from a VAT point of view? Remember, if I basically initially took your funds and I bought, make it trade in stock. Let's make it easy. We basically bought trade in stock on credit. I bought trade in stock on credit. When I buy trade in stock, I got an invoice. That invoice is going to be giving me an entitlement to claim an input VAT credit itself. So I claim my input on presentation of invoice, because remember the time supply, the earlier of invoice or payment. I don't have to pay to get the input as well. Right? Similar to income tax, I don't have to pay to get my Section 11A deduction. So I got my input tax deduction. When the creditor writes off that itself in my hands, what's going to happen naturally, as you correctly say, is that it's going to trigger a Section 22 output tax declaration by me. So there's technically an output tax adjustment that I'm going to have to correct, because I previously claimed an input tax deduction. Now when the debt is written off, what's going to happen is I'm going to have to reverse that by basically triggering an output tax deduction itself. In your examples, and Arthur wants to know what happens in the hands of the creditor. So Arthur, we're getting exactly to that point now. We're going to flip our thinking in your examples, what is happening, and I can see you're thinking about the debtor-creditor implication. So I like to disconnect the two and first to deal with the taxpayer separately. We're exactly going to basically be dealing with that issue right now. So we're going to flip into the other company itself. So let's have a look at that. We're going to basically now concentrate into the hands of the creditor. So let's have a look at this here. Quick poll question again. If you can help me to run that from your side, Danny. When a company writes off a loan due to it, so remember now we're into the creditor company, flip your focus itself. It can either claim a bad debt allowance in terms of Section 11I. It can claim a capital loss. It can get no deduction of capital loss, nothing for it itself, or it really depends. So what's your thoughts on this now? Remember, we flipped in it. We're in the hands of the creditor, the person that provided the loan funding, and they actually can't get their money back. We are talking about that guy. And he says, I'm writing off my funds that are due to me. what's the implication in that company's hands? Is it going to be a bad debt allowance that a company can claim? Is it a capital loss, no deduction, nothing happens, or really it depends? So let's have a look and see what it basically, what your thoughts are on the matter.
While people are answering, did you see the question about the company providing assistance to a startup company B?
No, I didn't. So let me have a look at that one in the meantime. Thanks for that, Danny. So company A provides assistance to a startup company B. It's consulting services, which it charged for, and loan funding. What is a situation where the amount charged for consulting services is consolidated with the loan funding into a loan account? Does the consulting service debt retain its identity as revenue debt, or does it become capital debt? So the question really is, in this case, you've got a company, it's company A, it's providing assistance to a new, so it's providing loan assistance, the way I can see, to startup company B. Startup company B has got no funding, and it also provides consulting services, which it is charging for. We always say that tax is transactional based after, so split the transactions itself. The one is going to be the loan account, which the startup company is going to take that loan money and they're going to apply, probably they're going to buy tax deductible assets, and they're going to pay some tax deductible expenditure itself. Then disconnect that and see that the consulting service that company A is providing also to company B, that's almost like a transfer price intercompany service that's actually happening. And that's a revenue, as you correctly say, that's a revenue event itself. And that company, obviously, company B is going to pay, get a deduction for consulting fees itself. And if you one day write off that loan account itself in your hands, we're going to see now what's going to happen as a creditor itself. But we've already unpacked the issue in the hands of the debtor. Simply, if you're going to write that off and they got 11A deduction, which I can see they would have got on the consulting fees, that's going to trigger a simple recoupment in their hands itself. So again, I think quite simply to make things a little bit easier for yourself when you face with a situation like this, we always tell all the students, I've got my two clerks also attending today, Ilsa and Evans as well. They'll always tell you that I always say that identify the transactions and split the transactions separately, because for tax, each transaction has its own tax event. And after, think about this as well, because not only are there going to be income tax, we are talking about income tax implications, but in both transactions, I can see here there's going to be VAT implications if these are VAT vendors as well. And in your two examples, there's going to be different VAT implications. In fact, on the capital loan, you know that's a financial service that's going to have no VAT effect, whereas on the consulting fees, that's a VAT, probably a VAT supply, and that's going to hold VAT consequences. But can you see if you consolidated the two together, we would not come to the same answer itself, and it's going to be difficult to actually determine what's happening. So Danny, back over to you. I don't know how's my polls going at the moment, and how are people actually voting at the moment?
I don't know if people got distracted by that, but let me just see. I'm going to close it because I've had time. They've had about 4 minutes to answer. So let's close it off. Oh, wait, the people now remembering to answer. Let's give them a few seconds.
Sorry, so they may have been listening to me. So that's good students. They've been like good students.
Yeah, I'm going to close it now. Let's see what the results are.
Awesome. So I see, oh, I like that. So can the audience see the results as well? I'm sure of that, Danny. So 15% said bad debt allowance, section 11I. Some said capital loss. Some, well, nobody said no deduction. I can see you people are consultants in the market space. They all want something to happen there. And then a lot of people said it depends, 74%. I like that answer because we're going to basically go through the implication and it really all depends. It depends. And Arthur's question triggered the issue actually. You were trying to ask whether it's actually capital or revenue itself. It depends. What is it? All right. So let's have a look. When you're in the hands of the creditor and the creditor writes off a loan account itself, you got to ask yourself, first of all, is that debt a trade debt? or is it a loan account? Distinguish between the two, because that's going to help you to determine the income tax implication that's going to flow. Now, let's first deal. If it is a trade debtor, right, what's going to happen? Think about it. Very easy. It's going to be a Section 11I deduction, because when I sold trading stock to you on credit, I paid gross income tax on that income tax number. If I write it off, I must get a 11I deduction, similar to Arthur's question. From a VAT point of view, I claim the input tax deduction, right, in the hands of the buyer. And when it was written off, we had a reversal of that input as an output. Now, if it is in the hand of the creditor for VAT, when he sold it, he declared output VAT. When he's going to write off the debt, he's going to get a Section 22 deduction in terms of, he's going to get a VAT input deduction as well. And what is basically going to happen, as we can basically see in the hands of for income tax purposes, what's going to happen is that when I write off the debt, I'm going to get the Section 11I deduction itself. Obviously, I first need to meet the scope requirements of 11I. The fact it was previously income tax was paid off, it must be written off physically as bad. It mustn't be one of those that you thinking you're just not going to collect on. You must have instituted legal action itself to collect the debt, and you couldn't have gotten your money and you wrote it off. If it is a loan, Arthur's question, right, then it is just a loan account. And what is loan? Loan is capital in nature, isn't it? Then the question is, can you get that capital loss? Because actually, this is a capital loss for you, isn't it? That's exactly what it is. Think about it. Let's run a simple example. I give you 100,000 Rand, right? Just a loan, right? I will call you debtor on my books, if I still remember counting right. On my books financial statement, I put asset there and I call you a debtor and I say you're an asset, you owe me money, right? Now for 8th schedule, when there's a disposal of an asset, now remember, a write down of a loan, read the act itself will tell you, is a disposal. Writing down something triggers a disposal in terms of the 8th schedule. And if it happens to be in relation to an asset, which I just call you a debtor, an asset on my books itself, I have disposed of an asset. So there's a disposal. And when we have a disposal in the current year of an asset, we run CGT. And CGT is proceeds, the amount you pay me. And if you gave me 0, there's my proceeds, 0. And my base cost is the debtor value, which is 100,000 in the example, i.e. I just made 100,000 capital loss over here, right? Now the thought process over there is that if it is between non-connected persons, then it's no problem. I can basically get it. I mean, there's no issues. I'm basically done and dusted. I get a capital loss and I'm basically happy. If it is between connected persons, there are 2 paragraphs in the 8th schedule that come into play. The first is paragraph 39, which you know about, I think. It's a default one, which says that between connected people, no losses. Those losses will be clogged. What does clogging mean? You can only ever use it against a capital gain with the same connected person itself. However, if we are dealing with connected persons we're dealing with debt written off between connected persons, we have a more special rule that comes into play, and that is paragraph 56 that tells us how to deal with it. And what does 56 say? 56 says the same that 39 says. It says disregard the loss between connected people. We don't want to generally give as the capital loss itself because you guys are connected, unless the debtor has a base cost reduction under 12A, my connected party, or my debtor has a gross inclusion in gross income under Section 19 because of a recoupment. We've just run through all this implication when this happens in the hands of the debtor who's connected to me, or the acquirer of a debt is going to have a gross income inclusion or capital gain one day when they dispose that debt itself. So this day basically broadly saying if you sold the debt, you sold it to a debt factoring company, and one day when the debt factorer is going to sell it, you know it's going to be gross income for them, or alternatively, it's going to be taxed as a capital gain. In that case, we're good to go. We can basically claim the capital loss and we're back into a smiley position because we basically got our capital loss going over there and we are basically sorted. So that's the more specific, and remember 56 will overrule paragraph 39 even though the general rule between connected parties says disallow the loss, clog it, and only use it in the future with the same connected party. The more specific rule, paragraph 56, fine application between connected parties where debt is written off, and you can potentially, if you meet the requirements, claim that loss. What it's saying is that if we've already taken back the past benefits and allowances and we sorted out the data on the income tax implications, then, well, why shouldn't we allow the connected party to claim the capital loss in his hand? So policy point of view also, it makes simple sense. So we're going to deal with a short example together just to understand it's not a difficult example. I know it's late already. We've probably got about 10 minutes to go, and then we're not far from the completion. So company A and B are then connected, right? That's important because we're seeing connected persons in relation to each other. They're not part of the same group. Company B's year of assessment is then 30th of June. That's important for tax. You know, that's our year end. And our year of assessment, in the first year of assessment, 30th June, on 1 July, what had basically happened is that Company A lent Company B 2 million rand itself, which Company B used to acquire land from Company C at a cost of 2 million. So who's the debtor here and who's the creditor? Let's just sort this out first of all. Company A lent Company B. Company A is my creditor. We all agree with that, right? And Company B is then the debtor itself. There's my debtor company over there. And obviously Company B is the guys that now took that loan funding and they went and buying land from a third company, Company C itself, at the cost of 2 million. So if we're going to write off the debt, we're going to basically see what's going to be the implications. And now we can deal with both because I've taught you the implications in the hands of the debtor and creditor. Let's have a look on 1 July the following year, or year 5 years later. Company A waives 500,000 of the debt owed by Company B because Company B's inability to settle the full debt. The land was not disposed of in the prior year of assessment, and none of the exclusions apply. What is going to happen itself in the hands of the debtor and the creditor? So the first thing, we're going to see that the debt benefit is 500,000. And since Company B, which was our debtor, they will have to, because it funded a non-allowance asset, the order of application was first reduce the base cost. And the land is still on hand. So what we're going to do in Company B, the base cost of the land is now going to be reduced by 500,000, and Company A will therefore be allowed a 500,000 capital loss in relation to the waiver of the debt, and this will not be clogged under 39. It is allowed to flow through under 56 because my connected party debtor had a base cost reduction under paragraph 12A. Remember, that was a rule. I told you, if there's a base cost paragraph 12A being applied in the hands of the debtor, that will unblock in the hands of the creditor the loss, the capital loss that can basically be claimed. And it's exactly that principle that has come through that we sorted out. I've basically got a quick poll again here before we deal with the last point of order, and it's the last issue relating to debt waiver itself. Sometimes funny things happen where we have what we call a debt substitution. So I just wanted to alert you to the debt substitution, and that's going to bring us to the end and the closure of the lecture itself. So Company A transfers an asset in full and final settlement of a debt where the market value of the asset is greater than the face value of the debt. And do you think it will have no consequences? There'll be some CGT implications, or there'll be income tax implications on the debt written off. What do you think? Right? So remember, you got Company A. I'm Company A. I transfer an asset to you. I tell you, this is full and final settlement of your debt over there, where the market value of the asset that I'm giving you is greater than the face value of the debt I'm owing you. You should be thankful. I'm giving you more than I owe you technically, isn't it? Right? Is it going to, in your hands, have no tax consequences? Or do you think there's going to be some CGT implications in your hands itself? Or is it going to potentially have income tax implications on the debt being written off? What do you think? And Danny, I'm in your hands. You guide me in terms of how the numbers are coming in and the polling is going.
We have a quarter of the people have voted, so I'm going to give them a few more, give them a minute. There's still answers coming in.
Perfect. I'm happy with that. So just to answer the question that's come through in the meantime, Danny, so surely it depends whether the lending company is a money lending company, then it can be a revenue loss. I fully agree with you. And therefore I said the first port of questioning is this a revenue debt or is it a capital loan? Because if it's capital, it's a capital loss, right? But if it's revenue, and this is a money lending company, obviously changes the whole facts. Like, for example, a bank, that's their business. They pay income tax when they basically receive income back from you. That's a trade in stock for them when they basically lend in you money. So obviously that's going to change the circumstances and the implication. And I fully agree with you. That will trigger then that's obviously going to trigger a revenue loss, and it's going to be a Section 11I, the way I discussed it as well. So that's just to close out that question that I picked up on the chat line as well.
Okay, so I'm going to close the polls and share the results.
Okay, so I see, I'm happy with that. So 68% of the class are sort of where they needed to be. So there's going to be some kind of CGT implications in your hands. Obviously, there won't be no tax consequences. We're going to see how that is going to unfold. And I see some people said that there's income tax implication of the debt written off. Now, remember, in our example, there is no debt waive. I gave you more than you were basically due. You know, if I was a shareholder in the company or something, or if anything, one can argue that is a potential donation basically being made by me, because I'm giving you more than you due to you. So if anything, if that's done gratuitously, one could actually argue on that additional element that is gratuitous in nature, and if anything, I should be paying donations tax on that rather than the debt being waived itself. So let's have a look at that substitution paper 34 and how it basically works. So we basically have a company A over here, and they basically owe 100,000, let's say, to a company B over there. And what happens is company A now transfers an asset at market value, which is 120 market value, to company B as final settlement of this 100,000 loan that's actually due. So I'm giving you more. I'm giving you an asset which is 120, but I only owe you 100K. So you're actually getting more. You're scoring on the deal. You should be happy about this here. There's no debt benefit in this debt settlement or this debt substitution agreement. It could happen. I'm not saying it couldn't. Practically, it could happen. I could give you 80, asset only of 80. Then yes, then I agree. The 20 would have been basically a debt benefit, as most people said, that 29% of the class basically went over there. So what's going to happen in company, let's identify the taxpayers again, strip it out so that we can make sense of it and sort it out. In company A, what's going to happen? We have a disposal of an asset, because I gave you an asset. That's an asset disposal. What must I do? I must calculate if it's an allowance asset, the recoupment, if available. If it's not an allowance asset, it's just an asset, then I'm going to calculate proceeds minus base cost. What is my proceeds? Proceeds is the value of the loan account itself. That was basically, because remember, I've given you an asset. What have you given me in return? You basically squash my debt of 100, isn't it? 100K. So what is proceeds? Whatever I receive, I receive 100 from you. And base cost for me is going to be whatever I bought that asset whenever, a couple of years ago. There's my base cost. So I'm going to have to run the CGT comp on here. I'm only giving you the proceeds, but there's obviously going to be base cost, and the base cost will be whatever it was, you know, when I acquired that asset itself. And that's going to give me a CGT calculation. If this was an allowance asset, I would first have to run the recoupment and then the CGT comp. So first calculate the recoupment, and you know how to run that calculation over there. Let's look at company B. Company B then disposed of a loan itself, because remember when I write off, what did I tell you earlier? When you write off a loan account itself, remember this guy, he had 100K and he called me debtor over there, he put me as an asset on the balance sheet. When he wrote off that loan account, it's a disposal of an asset. So he's going to want to go proceeds minus base cost. What's his base cost? It's the value on the financial statement, which is 100K. What's proceeds? Proceeds is going to be the value of what he received. What did he receive? He got an asset at market value of 120. So he's going to calculate the capital gain or loss of, in this case, a capital gain of 20 itself. And very importantly, all para 34 is saying is that his new base cost, this company B of that asset acquired, is going to be equal to the proceeds, basically, that he's not, it's going to be for some people, because some people have argued that base cost should actually be now 100. 34 just reconfirms that I think a logical rule that the proceeds is actually equal to 120 in this example itself. Because if we were going to actually make this 100, then what happens is that we reset in that to 100 when we've already taxed him on 20, obviously. Because we taxed him on 20, that 20 must be added to the 100, and his new base cost is the capital gain plus his old base cost, which is basically then the 120 itself. And as I've said, some people may argue, and that's the reason purely for 34, is that this is not 100, this is actually then 120, it's equal to the proceeds itself. So I hope that basically clarifies that position itself. And yeah, then it almost brings me to the close of my lecture. I just want to deal with some questions, and then I can basically do the final poll out question. So whilst you're looking at that poll, it's not a technical poll at this late hour of the afternoon, and it is 1 minute past 4 already. So you can answer that. I now understand that waiver implication somewhat. I have a better understanding than before. I can identify where at least there are tax implications and rather refer the stuff to a tax specialist. This is just too complicated for me, and I guess I'll never know tax implications of that waiver. So let's see a little bit of a fun poll over there, but I'm going to deal with the questions in the meantime that's come through itself. So Sonja wants to know what will happen if the loan agreement states that 20% of the loan will be written off if 80% of the loan is settled within a shorter period. The lender gives you a discount for early settlement itself. So in this case, what's going to happen is that there is still going to be a debt waiver that's happening. That discount factor, Sonja, that you are talking about is going to be a debt waiver itself. That's very importantly, that's because remember for tax, we read it into concession compromise, those words itself. And any cancellation, you'll see any settlement, any cancellation, any discounts, it will be all written into the language of the Act. It's going to catch this into that portion as well. And Herman, you want to know what happens if the debt owed was a trade debt which was settled with an asset worth more than the trade debt owed itself. So let's have a look. So you have what happens if the debt owed, so you have a debt owed here, which was a trade debt here, which was settled with an asset that's more than a trade debt. Again, I think what's going to happen in that case is that in the hands of the company who has a trade debtor itself, right? So the loan account itself is due to this company in the hands of the creditor. What's going to happen? He's got a trade debtor due to him. He's going to basically have their trade debtor on his balance sheet. And now if he has an asset that's coming to more than that itself, the value of that asset is going to expunge and reduce the trade debtor account itself. And that excess that he gets, it's going to have no further implications for him. What is going to happen is that his trade debt is simply written off, and we'll again use the debt substitution rules, which will basically tell us that going forward, his new base cost is going to be equal to the market value of that asset that has basically come and walked across. That's going to be basically his market value of the asset, because he now acquired an asset going forward, which settled the debt. Then in the hands of the company that waived the debt or transferred that asset itself over and walked the asset over in that company's asset, they're going to calculate the capital gain or loss. But I think that because they're transferring asset in excess of market value, that additional could be seen as a donation. It could potentially hold donations tax consequences and implications. Again, one would have to look at the scope and requirements of the Donations Tax Act, whether any of the exemptions could possibly apply. Obviously, if it is by a company, if it's between connected persons, we have exclusion and exemptions in the Paragraph 56 of the Income Tax Act, and that could possibly basically exclude the donation tax. But otherwise, I think potentially you have a donations tax implication that's coming out over there. Danny, then back over to you to ask you how the...
Yeah, I think I'm gonna end the poll now and share it. No.
Oh, so at least I'm really impressed, Danny, with the results that I'm seeing. So a lot of people saying that somewhat they do understand. 6% have come back and say now they can probably they understand something about that waivers. At least they've caught something about it this afternoon. But 69%, I'm impressed by that, guys. I have a better understanding than before. 70%, almost 70% of the class coming through. And 17% is saying I can identify when there are tax implications, and I know that I need some help in this regard. And only 8% is saying that, well, this is you know, this had to come up in an exam. I think I'm doomed. I'll fail it. This is just too complicated, and I think I'll never get my grips on this itself. But I hope I've added value, Danny. You'll tell me when I come back. But I know you've been, and apologies from my end, you've been hounding me probably for 2 years now. And yeah, things have just been so hectic on my side. This new world order is worse. You know, I always say things, you think you've got more time with the new world order. And yeah, it seems like we're even working harder and faster and more. So the little time that you had, the time to yourself, which you actually had when you should drive to work, is now also taken away. And that has become work time. So things have got rather complicated, but I'm happy to come back, you know, anytime to help out if there are, you know, if there are other issues again.
I think there's one more question, I think, before we ended it.
Let me have a look. Yeah, Herbert has got a question coming back to the debit shareholder question earlier. So as long as the shareholder himself declares a capital gain, is it okay for the company to claim a capital loss itself? So no, Herbert. So remember, in this case, what's going to happen is that because they are a share, they're going to definitely be connected. I don't think it's going to be like a 2% holding that you're talking about. Let's assume it's 100% holding and they are connected parties, right? So the default over there is going to be that if it's a capital loan that was basically made, what's going to happen is that in the one party that we can basically in the debtor company, and let's assume that the debtor company is a company that took the loan funding itself, and they basically applied it to tax deductible expenditure, right? So as long as the debtor company either reduce their base costs or they have a recoupment and they have all the tax benefits removed from them, that's going to allow the connected creditor company to unblock and claim the capital loss under Paragraph 56. So that is the thought process. We don't need a capital gain loss exactly in the same sense itself. What we do need is that all the rules that I showed you, as long as we have the tax implications removed in the hands of the debtor, then the connected party creditor will unblock and claim their capital loss itself. So it's very important to go through all the rules itself and the issues. I've just about written an article, a credited article, together with a colleague of mine at work, and we submitted it to, funny enough, the Journal of Accounting and Financial Sciences, our Jeff, our own UJ articles journal itself, and it deals specifically what I've raised in that article and the issues we look at is the whole issue about unfairness, because you know that things are extremely difficult in the market space at the moment and companies are struggling. And what I've taught you this afternoon technically is that it can trigger a tax implications in a struggling debtor company when their loan is written off in the company's hands. So where there's a recoupment triggered, and it's not only catching the base cost, you will agree with me that it's going to even place this company, well, these guys can't even pay their loans. then a lender comes across and say, you know what, I'm willing to walk away from my loan funding. SARS steps in and say, hang on, you know what, you actually owe us tax on that loan that was written off. We'll just trigger a recoupment. These guys can't even pay the loan itself. How are they going to pay SARS? And I've written an article which is pleading with SARS basically to say they must consider some kind of time in relief at least, even if they don't want, and I'm not going against policy here and saying, from a policy, I can understand that if you got a past deduction or allowance or a benefit, it must be taken away from you because you didn't ultimately pay for it. I'm not against that policy rule, but what I'm saying is that in the advent of COVID, we've got time in relief coming to all the time. We've got further time in relief announced now a week ago, isn't it last Sunday when the president stood up and said that they're going to further provide time in relief on provisional taxes itself. Why can't we get time in the release in this instance? Why are we shutting down all those restaurants? Why are we killing those businesses itself? Because once they're gone, they'll never come back. So yeah, I've been arguing on this point as well. And it's something, Danny, when the article gets published, I'm happy to share it with you. I'll send it along for your members to actually have a read through that article as well.
Thank you. I think that will be appreciated.
Thank you, Muneer. I just want to say that I've got the president on the line. He wants to know when you can take over from Pravin Gordon.
Geez, that's a difficult stand. That's a difficult shoes to walk into. You know, I would not want to do it. I must answer almost like the guy. What's that guy from The Gift of the Givers? It's some politics. He said it's something I don't want to do. So I'm going to answer like him. Politics is not for me. I'm going to stick to taxation and what I know.
No comment at this time.
No comment now.
So everybody has to have had a better understanding, or must now have a better understanding than before, whatever your understanding was or whatever the baseline was. I really want to thank you for most interesting session. And, you know, Danny's going to keep nagging you to keep coming back. So I think you've headed in the right direction, whether you wanted to or not. But really, thank you on behalf of everybody. Thank to everyone for joining. We still have to wrap up from David Tucker. He's got, I don't know if there's any questions on that score. So we'll be closing out Muneer, and thank you again. And David Tucker, I don't know if there's any questions for David Tucker at this point.
Stan, maybe if there are, they can email me. I will give or I can either get them through you or Danny, or I can put my contact details on the pack when I send it to the people.
Okay, the hour's late. Just for the benefit of those attending, your certificates will be on your way and on their way in the next couple of days. And thank you everyone for attending. Just in terms of the third wave, don't contribute to the possible fourth wave, and please stay safe and look after yourselves and your families. And thank you from Danny and myself and CPD courses, and we'll see you soon.
Thank you.
Leaving now.